And good morning, everybody. I nearly said good afternoon because we are meant to have started at 9 and we're starting all hour later, and I cannot apologize more than you can actually think I can. I don't know what happened this morning. I live 4 k's down the road and it took me 2 hours and 15 minutes to get here. And so we're going to start with a cup of tea, and you don't know if my cup of tea is laced with anything at this very moment. So I do apologize and hope that we're going to run quite smoothly. I had this session booked for 5 hours, which was 1 hour more than I actually need, so I'm very grateful for that. And that is only so that in case we were running a little late with questions, etc., at least I had some time to actually cover that as well. But I think we're going to do fine, not a problem whatsoever. We're going to do our normal little stint. And let me just explain how I try to run. I will talk for about an hour, and I think after that you guys get quite tired of my voice, and then we'll have a little break. The breaks probably will not be as long as I originally planned. And then we tend to go for another hour and then take another break, and off we go. What I'm going to ask of you is, because there's quite a few of you and I know there's going to be a lot of questions, is to please, as I cover a particular topic, please do text me those questions. And then what I do is every now and again I take a little bit of a break before I go to the next topic just to look at what those questions are. Some questions I will probably not address immediately, not because I'm ignoring you. It's because obviously there's going to be a lot of questions. I've got to try and cover the material as well as questions as well. But if there's anything that I cannot address, I will let you know that I cannot address it. I will make a particular note, and I'll make sure that FPI actually sends through the question as well as the answer through in terms of an email. At the same time, I'm going to ask you to please take my email down. It's Carmen Venter at discovermail.co.za in case there is anything that you think of afterwards or something that perhaps I have not addressed that you would like to address. I'm quite happy that you actually send me those emails as well. So let us start. You'll notice that one of the things that FPI did do is send you some past exam papers, but if you do go onto the website, there's a lot of past exam papers, there's a lot of notes that we have set, and when I've said we, it's the presenters over the years. The memos are available, the question papers are available, and I myself sent you last year's case studies that I worked on, case study 1 and 2, with my solutions, and I'll tell you a little later why I have done that. I think it's very important to go through that because you'll notice from a trend in the exam guidelines, a lot of things are actually repeated. You need to know your TVMs, you need to know how your tax calculations work, you need to understand your business entities, and of course from a phase perspective, and we're going to touch a little bit on each one of these. But because of the fact that there is a trend, clearly then, going through some of the past exam papers, even though you might not have solutions to it or you might not have complete memorandums to it, do yourselves a favor and go through those questions, because those are the type of questions you're going to have to address. The level of the question, the level of your knowledge, and also the level of your application. So do yourselves a favor and go through that. But one thing that I will not be addressing clearly on this webinar today is any of the, if those of you who have gone through those past exam papers and have read some of those memos, I don't want to debate today whether those solutions are actually correct or not, or how I would address those particular questions. If you want to, by all means, take advantage of the fact that I've given you my email address, and I do not have a problem if you send me those questions, and then we can debate it. And of course, when necessary, I'm going to try and get FPI to send you those notes or any additional, but you must understand we also do not want to inundate you with documentation, because you've got sufficient enough. Now, what I have in front of me you do not have. This is because I was just working through the guidelines and decided to add a couple of extra notes. This will be sent through to you, but this is not a problem. One of the things I think is important from our education point of view, the way we study, is perhaps by seeing what I've got in front of the screen at this very moment and listening to what I'm going to say, and the fact that you've got to write some of these things down, that just means that, of course, you are going to perhaps remember a little bit more. And I also want your imagination to run a little wild as well, because sometimes when all the notes are given, We just concentrate on those particular notes and we're not necessarily thinking. So I want you to do that. So you're going to see on your guidelines, you will always have something to do with phase and the FBI Code of Conduct. You must understand that, of course, this is what you're doing. You're writing the board exam for the CFP designation, which means that FPI is going to be testing you with regards to the FBI Code of Conduct, as well as things like your practice standards, etc. So this is what we're sort of just going to run with right at the beginning. And I'm just selecting my little pen and making sure that it's there. So notice what I've tried to do. I've looked at your guidelines and sort of worked out, you will get 2 case studies. I don't know what the mixture of these case studies are going to be. If I take a look at past exams and the trend, you generally will find that there's one paper that is investment based, and then you have another paper that is more your business assurance, your business entities, your taxations, your lump sums, you know, what I nearly call the softer issues other than investment. So this has been the trend. But one of those papers, or even in both of those papers, there's going to be a combination of obviously the whole phase setup. Okay, so I'm going to have to tie up some of these things, and clearly look at what I've tried to tie up. I've said your practice standards are definitely going to be linked up with the fact that they've given you certain case law, which you have to please go and pull out. Please go and read that. And those practice standards with what has happened in those particular case laws that they have asked you to look at, as well as ethical decision making and financial planning, will all be one component. I'm not saying that they're all going to be one particular question and one case study. They can be in both of your case studies. But what I'm saying is you cannot look at them separately. You've got to look at them in conjunction with the other, because one reads with the other. So our practice standards, if you look at our practice standards, we're going to be looking at things like your skills, your knowledge, and your ability. And in summary, that is firstly understanding that, of course, we've got a code of ethics, and with that, we've got our general code of conduct. Okay, so when I'm approaching the client, how ethical am I? What is my code, my conduct like with my particular client? Take a look at the type of information that I'm going to be needing from my client, okay? My ability to actually extract information from that client, and of course my knowledge and my ability to then go back and apply it. So that's what we're looking at. And I always say, when you go and see a client, just think of it from a financial planning perspective. When you go see a client, your client is not going to sit there and then just spew out every single bit of information that you feel, or rather that the client feels you need. They're not going to say, oh, here's my information for you to do a CGT calculation, and here's all my information that indicates to you whether I am a conservative investor or a risky investor. They're not going to do that. You are going to have to use your skills, your knowledge, and your ability to be able to ask the relevant questions from your client, and then at the same time establish what bit of information your client is giving that is actually relevant to what it is you're needing to do, i.e. what was the objective of the client in the first place? Why did the client want to come and see you? So what are the client's needs? What type of information can I pull out from the client so that I can do a proper and holistic financial plan? And of course, ensuring that in that whole decision-making process that it is ethical, that I'm actually looking at addressing the client's needs. So what has this got to do with a case study? Well, I think from a past exam sort of trend point of view is that what happens is that you are not picking up all the facts that the case study is giving you. We are homing in on only one or two little aspects. We try and address only that one or two of those little aspects. So we lose the plot totally. We are not answering the question, specifically not answering the question, and we're also not applying it to the client. Why? Because while we're reading the facts of the case study, we are not showing the ability of extracting the information that we need. And a lot of this information, ladies and gents, are given to you. It is in the facts. All you have to do is identify what it is the examiner is giving to you, and obviously understanding how to apply that to the case study. And all this is what we are testing: your ability, your skills, and your knowledge. At the same time, we say, can you apply that in terms of financial planning, your holistic financial planning, and ensuring that you're always ethically considering the decision you're making. This is for the client, this is not for you. And what we are clearly going to do is we're going to be taking out the principles of these case studies, or rather the case law. We're going to be taking out the principles of those case laws that we've asked you to read, and we're going to say, in addressing these case studies, are you able to actually identify those principles, see what is wrong, what is right, and then apply it yourself? Now that's the type of testing we're going to be doing there. I don't think that there are very post-grad type in questions that says list the 6 codes or list the 5, etc. Okay, this is you understanding those code of ethics, the general code of conduct, the case law we're giving you, and your ethics in applying that particular decision-making process. So that is the whole phase bit. I'd like you to also, if you want to, tick the bits that I've covered in your guidelines so that you know that I've covered everything, and what I have not covered, and clearly you can query this with me. Okay, so the next thing in your guidelines, and this was a very difficult one for me to actually send any form of concrete notes on, because it is very subjective. And this is the first point in your guidelines, and it ties up with quite a bit. So let's just go through the process and see what does it actually tie up with. And this is, your guideline says, the current global economics, market conditions, and how it impacts on South Africa. And I think very cleverly in this guideline it says that you are expected to do your own research in terms of what is happening, and not only the knowledge of what is happening, but how does it actually apply in terms of South Africa. Now this is that's why I'm saying this was very subjective to me, because when we had, and what did we have recently, what I've done is I've just sort of listed what I can recall has happened in the last year, and I'm looking globally as well as things that have happened in our country itself, because I think that's part of the whole economy situation. Something happens here, something happens overseas, the two impact, and we either have a train smash or we're all particularly smiling. Now I'm not necessarily going to go through each one of those, but you know, in South Africa itself, what happened last year in terms of our finance minister and how concerned we were whether Provident was going to be able to keep those credit ratings from being downgraded. And of course what hit us was the whole student unrest, okay? And what has happened in China in the last year itself in terms of their economic activity that has declined. The fact that Brazil and Russia's recession, obviously we're on the cusp of recession itself. And then what has just recently happened, the whole Brexit thing. Of course we didn't expect the results of them pulling out of the European Union. So I think just before the actual deadline, the markets were doing pretty well, then all of a sudden we all got a bit of a shock, and then we woke up the next morning to realize that markets all of a sudden hit a downer once again. And then of course I as a financial planner was inundated with emails from a whole lot of investment advisors, a whole lot of investment houses, CFAs, etc., economists, a whole lot about what we should be doing with our investments, i.e. this whole Brexit setup. What does it actually mean to us? And there was a lot of contradiction. And even recently when I open up the newspapers, I still read a whole lot of contradiction. It doesn't seem like anyone can actually specifically say to you what we should actually be doing, what we shouldn't be doing. What I have done is, and maybe this is something I should actually scan to you, but I am sure a lot of you actually buy the Saturday Star. And there was a fantastic little article by Laura Duprier where clearly she has sort of written down what a lot of investment managers have said, a lot of CFAs have said, and I'm going to pick up on one or two. But basically, what the examiners are going to ask of you is the fact that we've had this impact, and I think more concentrate on what has happened recently. Of course, I don't think we've got to ignore everything that has already taken place, because we are already in problems. I mean, the fact that we were told recently that we're going to have no economic growth. You must remember the IMF at the time still said that perhaps we'll have a 0.8% growth this year. And now we're being told that there's going to be no economic growth whatsoever. Now we've got the whole Brexit that is also taking impact on our economy, South Africa specifically. So we've got to look in context with all of this. What is actually, how are we going to be planning for our clients? What type of recommendation are we going to be giving to our clients? So this is what we're going to be looking at, is in relation to investing, what should we be doing at this stage? Now this is just a little bit of the comments that I've been getting. Some of the research that I've made is, well, should we actually be pulling out of all our equities, not necessarily all our equities, but should we be pulling out of equities and going into more cash? Should we have a far more conservative approach? Should I be coming out of offshore, or should I actually continue being risky? Should I perhaps increase my offshore exposure? Should I leave my equities as it is? Should I be panicking? Should I not be panicking? I think it also depends on where are you in the market, i.e. I've put here, what is your long-term view? Are you only coming into the market now? Are you already in the market and you only have a short-term in terms of, let's say I only have 2 years to go for retirement and I have no choice, I have to retire because that's the retirement age on my, let's say maybe my pension fund, etc. So can you see you've got to kind of look at what are the facts of the case study. You understand what's been happening globally. You have a knowledge in terms of how that impacts South Africa. But now you've got to take that and say, what type of recommendation am I going to be giving my client? Well, you first have to actually read that case study. Who are you dealing with? Do not make general comments, okay? Because that is what the newspapers are doing. They're making general comments. No, 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 no. You've got to become conservative, change asset allocation, go more into cash, don't go into equities, etc. Don't expose yourself to offshore. That is very, very general comment. You've got to go and apply it back to your client. What is your client's timeline? What is your client's timeline? Should they stay invested, or should we perhaps go a little bit more conservative? Or maybe I've got a lot of time ahead of me in terms of that particular client's need and objective. So maybe I can ride the wave. Maybe I can make it a little bit riskier. Maybe I can have more offshore exposure because it's cheaper to buy. Now I also notice one of the things that's happening, it's a trend that's happening globally, and it seems like that South Africa is preferring going into a more passive type fund rather than active funds. Because an active fund, what are they trying to do? They are trying to make up any particular losses, so they're going to become riskier and riskier. So can we actually afford that? Perhaps what we should be doing is actually combinations of sort, but you can only see that from the type of information that that the case study is giving you. I'm going to go between case study and examiner because my mind is just a little bit between the two at this stage. So the trick of this whole exam is to understand what has happened globally. I've just given some examples, ladies and gents. It doesn't mean that this is what the examiner is going to be focusing on. I've just looked at from my client perspective and myself is what has just recently taken place, or what is added onto everything that's happened in the last year. And of course I read up about people's recommendations, etc., because that is important. Not only having my point of view and having other people's point of view is important, and then how does it apply to me? So what I'd like to do is just read. And it's a nice little article, but it's obviously a long article, but I just want to kind of like pull out a couple of things here in terms of what was actually said, And it says things like this: locally, now this is the Brexit turmoil, all right? So locally, the all-share index fell sharply by over 4%. Now this is not so long ago, I don't have the date, but this is a couple of days after the whole Brexit turmoil took place. Soon after, trading began for stabilizing at about a minus 3.6% by mid-afternoon. The price of gold hit a 2-year high, up about 6%. The rand fell by 5% against the dollar, although it was up almost 4% against the flailing pound. A lot of multi-managers are saying South Africans do not require to change their financial plans. Investment strategies should be built around your life events and life goals, not newspaper headlines and market volatility, they say. The other one that says a diversified portfolio remains the best way to manage the inherent uncertainty in investing, instead of a fearful concentrated portfolio of gold or cash. The other one says Brexit vote will drain investors' appetite for risk in global financial markets. It is unlikely to fundamentally change the global economic look. The other one says the pair say South Africa is likely to feel the impact most in its financial markets, and if the rand weakens further, it could place upward pressure on interest rates and inflation. I'm reading all this so that you can get an idea of how this actually starts operating or impacting your clients. We have another one that says markets don't like the kind of uncertainty that Brexit introduces, and investors will demand more for taking investment risk. This will cause the prices of shares and other risky assets to fall. But for you, as a long-term investor, the message is don't panic. The other one says focus on quality shares that it expects will stand in good stead in uncertain times. While markets will be volatile in the short term, long-term outcomes will depend on the economic policies implemented in the future. So I think the last one I want to sort of read out is it is important to keep in mind that while currencies, shares, and other assets can be volatile over the long term, they return to their fundamental values. This means that as an investor, you should stick to your long-term investment plan, even when short-term outcomes in the markets are volatile. So there's a little bit of contradiction in between, but I thought that was a very interesting article to read in summarizing what the Brexit turmoil could actually mean to us as investors in South Africa. Now remember, I know there's a question that's popped up, but I'm going to just push a little bit more and then I'll go back to that. Now remember, with all this, this is how the whole thing, I believe, is going to be tying up. Okay, I might be totally incorrect, but I'm looking at this particular trends. So I need to understand what is happening globally. Not only do I have to understand what's happening globally, I need to see how that impacts investments in general. Okay, now I also have to understand risk profiling. So can you see how all this generally is going to tie up with my client? So it's important to understand where you are in terms, or rather where your client is. We've got to look at what my client's tolerance is. We've got a risk profile, and you know, generally this risk profile is a couple of questions, and it's going to say I am conservative, not conservative, etc. But what we've got to also understand is the actual risk tolerance of our clients. And remember, behavioral finance also comes into this, how our client is feeling, the fear, the concern, everything around the particular client. Then we've got to look at the client's capacity, and we've got to tie all this up with what I've just set up at the top. Okay, because that is exactly what's going to happen. You are going to be given a client situation, a whole lot of facts, and you've got to kind of go and say, well, considering everything that has taken place globally and the impact that it does have in our country, how does my client's risk profile, tolerance, capacity, how does this all fit into that particular equation? And then I'm going to have to obviously recommend a particular asset allocation, all tying up to my client. And I've sort of repeated here a little bit in terms of, obviously, take a look at your client's timeline. What is your client's objective? What are the investments for? What is it that I'm trying to address? That is all very important, ladies and gents, when it comes to the actual case study. Now remember, I just want to quickly say this because before I forget. Remember, each one of us are going to think differently. Okay, so some of us are going to think, oh, let's go into cash. Some of us are going to go, no, let's have more equity exposure. Let's go more offshore. Each one is going to think different. I do not believe that there's any one of us that is particularly right or wrong. The important thing here is for you to show the examiner how you have applied the knowledge that you have, the understanding of what's happened globally, the understanding of how that's impacted our economy and how that's going to impact our investments, and what your understanding of the client, what the examiner is giving you, this particular client, your understanding of that client, your recommendation, be it go cash, be it go equities, is how you are going to substantiate what you are recommending to the client. If you are saying, no, the client's risky, they've got 30 years to go, so that's not a problem whatsoever, I recommend cash, can you see that the two just does not gel? So you are not showing the examiner a proper justification based on your client's needs, timeline, etc., on why you want to go cash. So that is important. I don't think you should spend too much time or have a lot of fear in terms of, are you going to be recommending the best asset allocation or the correct asset allocation? I think important is to tie it up with your client. Of course, there are recommendations out there. You've got to apply your own knowledge and your own skill and your ability. Sorry, I had to drink something there. Okay. Then, of course, what you've got to do, they are going to give you, remember what your guidelines are saying. Your guidelines are talking about fun fact sheets. Your guidelines are talking about annexures that may or may not be attached, but somewhere along there. Of course, if I'm going to be talking about investments and I'm going to be looking at whether you understand risk profiling, of course, the examiner is going to have to give you some form of investment information. There's going to be weightings on certain asset allocation. There's going to be some explanation of what assets this client has. So clearly you're going to have to analyze what your client currently has. What are the holdings that your client currently has? Analyze the risk level of each asset in relation to the whole portfolio, establish the actual risk level of the whole portfolio, and then compare it to your client's profile, its needs, etc. Then you've got to decide where your client is sitting at the moment, what your clients need, and what type of asset allocation should I be looking at. And that's how you're going to be looking at the whole risk profiling, adding it up to the fact that we've had global turmoil, and it's going to impact our country at this stage, our economy at this stage. So that's what I need you to look at in terms of the case study. And you can see that it's very difficult for me to send you a whole lot of notes and say, you should be doing this type of asset allocation or you should be making this type of recommendation. It's going to be your knowledge, your application, depending on obviously what the client has given you. But at the same time, they've also spoken about investments, the type of investments. There's something in your guideline. I don't want to spend too much time constantly looking at the guideline, but it does talk about your type of products, the type of investments, etc. Now we're going to look a little bit at some of the standard investments, but I think you've got to actually go and do a little bit of research in terms of everything else that is not there. Just remember, I can't give you every single type of investment that exists. So go and do a little bit of research, but at the same time, please don't forget, and this is the other part of your guidelines, is Regulation 28. And Regulation 28 comes up every single board exam. And that's not to say that perhaps we don't understand what Regulation 28 is all about, but that is a very, very important component when we are talking about recommending certain asset allocation and certain investments to our clients, because we have to know that if we are going to recommend anything that is governed under the Pension Fund Act, that we are going to be limited to Regulation 28, because Regulation 28 tells us what the maximum allocation is per asset class. So we've got to take that into account. So if we have recommended that our client takes out retirement annuity for whatever reason, because that might be a need, we've got to understand that there are those limitations. So are we going to perhaps combine different products so that your client, depending on the asset allocation you've recommended to your client, that they can take advantage of the full equity exposure perhaps, or the full offshore exposure perhaps? So please, you've got to remember where Regulation 28 comes in. So let us just make sure that we all understand, though, that Regulation 28 is relevant to every single product that is available, if I can put it that way, under the Pension Fund Act. So we're looking at occupational funds, non-occupational funds, so things like retirement annuities, preservations, pension, provident, beneficiary funds as well, don't forget that. And of course, if there's any annuities that are being generated from the fund itself, that all falls under Reg 28. But the minute I take money out, so i.e., I'm in a pension fund, provident fund, RA, preservation, name it, retirement takes place, you now take money out of your retirement fund and you're going to put it elsewhere. Where do we put it? Well, if I'm obligated to do 2/3, I'm going to put it into compulsory annuities registered under the Long-Term Insurance Act. That means I'm outside of the Pension Fund Act. Reg 28 does not apply to anything under the Long-Term Insurance Act. So your compulsory annuities, or your living annuities, your linked annuities, your conventional annuities, your voluntary annuities, if that's the route you're going to go with, let's say, your Provident Fund money, that is not governed. And I do not have to be obligated to look at Reg 28. So that's important to understand your pre and your post products as well, which is also in your guidelines. And we're going to touch on that a little bit later as we go along. So take cognizance of that Reg 28. I'm just going to take 1 second just to see what the question is. I just don't want a little note that says that you can't hear me and off I go. But this question says, where are the various case laws referenced? Paul, what you've got to do is you've got to take a look at your guidelines that were issued to you. And in your guidelines, it specifically says recommended study material, FSB appeal board cases. 2016 cases only, Jackson, Kamala, and the Louis group. So there is those references. So the guidelines are very important, and it tells you that recommended study material. Please don't ignore it. It says recommended study material. That is important. I myself have gone there to take a look what they mean in relation to your guidelines. And while we're at this, ladies and gents, the guideline says, your exam guideline says, I think it's right up, it says, point 2. All the points mentioned below must be studied, including all aspects relating to the financial planning components, which are. So I am only concentrating on the specific guidelines given to us, okay? The one that says guideline after taking note of the above. So the specific focuses, that's all I'm concentrating on. But that does not mean that's where it ends, ladies and gents. You read this, it's a 2-pager. You read it well and you research, and please understand every other component about financial planning. It's not only what I'm talking about today. Very important. I know there's a lot of you that are repeating this, these exams. This is your opportunity to please go and concentrate on things that you forgot about last year or that you didn't concentrate on. And important, but it's obviously everything that is told in this particular guideline. Okay, so let's move on to fund fact sheets. And of course, what I also have not given you is fund fact sheets to look at. I think part of your research is to go look at fund fact sheets and make sure that you understand all the fund fact sheets. It is very, very important, because in the past we have found that fund fact sheets are always given to you. I don't recall, or rather it's been a long time that I've seen a board exam that does not have a fund fact sheet. Clearly, because that's part of the recommendation in terms of investments. When we're talking about products, etc., that we are going to be recommending, there are going to be things like unit trust, but not only unit trust, ladies and gents. You might be recommending a share portfolio. And in recommending a share portfolio, of course, you're going to have to understand also certain ratios that apply to those investments that you are recommending. So please go and make sure you understand how to do share valuation. What type of ratios would you be using to value shares? Things like EPS, your PE ratio, your dividend yield, etc. Make sure you understand that as well. And then, of course, there are other ratios, and I've mentioned some ratios, okay? So we're going to be going through some of these things at this. I know you don't have it, but bear with me. One of the things that are also very, very important is please go through the past exam papers in terms of fund fact sheets, ratios, and how it relates to investments. There's been a lot of those. And I think it's important to look at some of the questions and then try and work out how, based on all the lectures that were given to you, try and work out how you would answer that particular question. And I've got a small little example here because it did throw quite a few people off. And I don't understand, or out rather, I don't understand why, because it was in the exam guideline itself, and not only that, it was part of the webinars and workshops that we did. I think it was August 2015, if I can recall. So where did we actually miss the boat? And the only thing I can think of is perhaps we understood what the examiner was after, but perhaps what we didn't know is how to extract that information from our fund fact sheets. Now, I think go and pull out August 2015 exam and go take a look at that. And what they had there was they had clients that were beneficiaries in a trust. And these beneficiaries, there was two very separate categories, and one category was income beneficiary, a beneficiary who wanted income. So wherever you were going to put that money, please ensure that income was generated. And then you had another category of beneficiaries, and what they wanted there was they just wanted capital growth. And the advisor had given them some certain fund fact sheets, and certain recommendations were being made, and you as the third financial advisor had to come along and say whether it was a good recommendation or not, or which fund you would actually be allocating. Now that was as simple as that, was what type of fund would you be allocating to these clients, knowing that one needed an income and the other one needed capital. And it seems that what a lot of people did was they actually pulled apart the interpretation of every single fund fact sheet, and then went and recommended the fund that they felt was the best based on all the information they pulled out, performance fees, TER, etc., etc., and then recommended what they thought was the best fund for the client. But what they did not realize was they were recommending a capital fund, a capital growth fund to the income beneficiary, and an income distribution fund to the capital beneficiary. So clearly all your justification behind that was not going to work because you have not addressed the needs of the client. So I think it's important for us to just look at some fund sheets, and I've got two there. I just pulled out two. Now you'll notice I did this particularly because very few of us actually go, and not all of us are totally aware of all the changes that have taken place, and I don't blame all of us for that because there's a lot of changes that take place. It's hard to keep up, but some changes have taken place, and those of us who do use unit trusts, collective investment schemes specifically, to recommend to our clients, have to understand there are changes that have taken place. So yes, I do have a 2012. I pulled one before 2016. So I know it's old, so to tell me that I'm not feeling too well at this stage is not what I'm after. I specifically did this. So I've pulled out this coronation fund. I have listed it as an income fund. How do I know it's income? You see, this is how easy as it is. And I might sound like as if I'm doing the obvious thing, but here's one that specifically talks about it. This is an income fund, okay? It is going to, so if it's an income fund, so clearly there are distributions of dividends on a regular basis. So this is the type of fund I would recommend to someone who needs income. But it's something as simple as this. When you're in the exam and you're so panicky and you're time focused, and sometimes we believe that the examiner is actually trying to trick us into something. We actually don't realize how simple it is when we look at the fund fact sheet to pull out certain aspects of that fund fact to say, well, is this what I should be looking at or not? The fact that if I had to do this for you, then I can understand that you've got to go and analyze these fund fact sheets very, very carefully. So if I had to give you 2 income funds and you had to recommend which one, then of course you'd have to merely pull that fund apart or those facts apart to see now which one applies to your clients. Then we are going to be looking at things like, obviously, the risk profile. What is the risk profile of this fund compared to what my client is actually needing, okay? I am going to be looking at let me see, the returns. Returns are important. Although these are past returns, they're actually important, and you can use certain ratios to annualize returns, etc. This is a monthly performance. So you can use certain ratios to actually annualize that to help understand whether this is a fund that you're going to be recommending to your client or not. Also, I am, of course, going to be looking at those fees, because those fees are important. If my client cannot afford a lot of fees, or if my client has specifically told you, I don't want to pay a lot of money to manage my investments, then fees become important. But if all I give you is an income fund and a capital fund, although I don't think they'll make it that easy for you, but if all I'm giving is an income fund and a capital fund, and I have these 2 categories of beneficiaries, then clearly, of course, it's going to be just as easy as saying, well, what is income, what is capital? And we tend to miss those little things. It sounds a little crazy, but we do tend to miss. Now, notice the difference here. Yeah, I've only given you, well, this fund only gives you total expense ratio, okay? And of course, total expense ratios has in the past included a lot of fees, including management fees, performance fees, your custody fees, your trustees fees, your audit fees, your bank charges, a whole lot of things. What it has also done, it's also included transaction costs. So it's included quite a bit, but I think there was a little bit of a concern of some funds did include certain fees, other funds did not include those fees, so it was difficult to compare a total expense ratio as well. So what has happened since January 2016? So now I have pulled out a very recent fund, and this fund, you'll notice that the aim of that fund is for growth. So of course here is very, very, if at all, any form of dividend distribution. So this is not ideal for someone who's an income beneficiary, someone who needs income. And of course this is very high exposure, so it's not something that I would be recommending to someone who's more conservative. But then don't forget, the fact that someone is conservative does also not mean that everything I'm going to be allocating is going to be conservative all the time. I could be looking at some form of balanced funds that I'm going to be recommending. So maybe having some exposure to a high risk is not such a bad thing. So of course what has happened is I think I'm going to be talking a little bit about it, so I don't want to spend too much time on the fund fact because we are going to touch on it. But there's a whole lot of information there, your net asset value, that is important. Of course, it's all equity-based. What else there? Here's my fee structure, obviously, that I'm going to be looking at. Now, this has been the change. From the 1st of January 2016, what we've done is they've split between total expense ratio and transaction costs. So there's that change that's come in, and I think it's something that they may focus on, something that definitely was focused on in the February exam. So I will not be surprised if it does come through again in this exam. So please do note that as well. And you'll see that what is really happened is your total expense ratio now excludes transaction costs, okay? So inside transactions costs, we've got a lot of things in terms of brokerage fees, we've got VAT, we've got STT, we've got quite a few transaction costs in there which you actually have to look at it as well, all right? So go and understand what those differences are and where the fees are actually sitting in. Also, some of the funds are going to give you some extra information which I think you need to go, please understand what it means in terms of your investments that you are allocating and in relation to your client's portfolio are obviously things like, what does standard deviation mean? What does the Sortino rate actually mean? Okay, so those type of things, important to go and research and make sure that you understand. And again, not only understanding in terms of the fund itself, but what it means if you come back to your client as what it means in terms of your clients and the investments that your clients have, all integrated, all very, very important. Okay, so I was trying to work out where did I bring in all these little valuations that I think perhaps is something that you should be looking at. And I noticed that what I did is I brought them under TVM. So I'm going to take a second break, just 1 second, because it means I just want to take a sip of my tea. And at the same time, what I'm going to do is just look at this question, and then we're going to spend the last 10 minutes before we have a break on TVM, discussing TVM. So Paul asked a question. Paul asked, so just to confirm, because I was talking about income beneficiaries and capital beneficiaries, and last year's paper specifically spoke about these clients that were beneficiaries in the trust. So, but this could be any client. This could be a client that is not a beneficiary. So this could be any situation. It's just interesting that a trust was used because we were focusing on trusts from a planning tool perspective. So the question here is this: if a beneficiary is an income beneficiary of the trust, you cannot give that beneficiary an income via capital redemptions. No, that's not what I'm saying at all. You see, this is why it is so important that, or rather, this is why it's so difficult to give you documentation that says, well, if you've got an income beneficiary, you're only going to give them this particular fund. Okay, this is important. I do not know what type of products, what type of fund fact sheets. I don't know if there's a share portfolio. I actually do not know at all what the examiner is going to throw at you. So the example I used was the August 2015, because after the event, we realized that what the examiner had done is the examiner had given certain fund fact sheets, and based on those fund fact sheets and the information given, we had to make a recommendation. So no, there was no talk at the time that yes, I can take capital and draw it, or any other investment that I would give to my client. So I think what you have to do, please, you have to go take a look at the case study. What are the facts? And you've got to go work with those facts. If they've given you certain information, don't go and now start thinking about Persian carpets and gold and heaven knows what else if it's not in that case study. If it is in that case study and you can make recommendations on using capital redemption instead of just a pure income portfolio, then by all means it's something you have to do. This is very subjective. It is taking what you understand, your knowledge, etc., and you applying it. Very important. Okay, so there's something else that Paul has given me, which I'm going to be looking at a little later. I think it's more fact than it is question, and then I'll share it with all of you. So let's just go back now. Guidelines. Notice your guidelines. Your guideline says TVMs. And under TVMs, it says a couple of other information. It says time value of money calculations, all calculations. So what I could do is I could spend a little bit of time here going through every single type of TVM that is possible. So I can go nominal to effective. I can go present value to future value. I can go payment to present value. I can do escalating. I can do level. I can do retirement planning. I can do amortizations. Can you see I can ramble on? These are calculations that up to now you should actually know how to do. By now, doing your board exam, you know how to do TVMs. But of course, what I've also done is part of the case studies that I sent through to you, case study 1 and 2, which was attachment. I've also given you a whole lot of calculations. I've given you education calculation. I've given you a retirement planning calculation. I've given you a whole lot of calculations. What type of calculations are they going to ask you? I don't know. But let's just go, if you go through your case study, okay, we are talking about Reg 28. We're talking about understanding your client. Under products, we're talking about retirement products. We're talking about, somewhere I tried to pick, cash flow and budgeting. So can you understand there are going to be standard calculations? I'm sure I'm going to be doing a retirement plan type calculation. And I think from the fact that I've got to do cash flow, understand budgeting and cash flow, I think there might be a CFJ, cash flow type calculation as well. So I want you to go and practice on any form of calculation that you feel that you still have a slight weakness at, and you can email me if you want. I want you to concentrate on your resultant rates. So I want you to concentrate just about on every single TVM type calculation because you're going to be tested on that. Okay. What they may do, because if you look at your guidelines, it talks about time value of money calculations. The PCE will always have calculations that a candidate must do. We understand that. Then it forms part of the practice standards in that candidates must be able to analyze, compare, and recommend the best solution to your client after considering the facts of the case study and all annexes provided. So I think perhaps what they're going to do is they're going to test your TVM ability. They're going to test your TVM ability, but they're going to just do it in the form of investments. So investments are going to be presented to you. Let's say, for instance, and take a look at, that's why I've sent you last year's case study, because what I did there was I said there that you had a client and the client came to you and the client wanted to understand what of these products, these two investments that were recommended to him, which one would be best suited for his needs. And one was an annuity. I think it was a voluntary annuity if I can recall, and the other one was a money market. And you needed to use your knowledge in terms of income tax, in terms of how those products work. Notice guidelines talks about products. How does a voluntary annuity work? How does a money market work? What are the tax implications of that? And how do I calculate the future value of these annuities or the present value of these annuities? How do I calculate which of those two are best? So I've got a feeling that besides your normal TVM calculations, maybe things like retirement planning, maybe amortization, because if I have to do a budget exercise, I'm picking up on things on the guidelines. If I'm having to do a budget exercise, perhaps in redoing that budget or understanding cash flow, I might have to do amortization. I might have to do discounting of future value into present value so I can understand what that investment means in today's terms. I might have to understand how to use TVM abilities to compound interest. Of course, future value and present value of escalating annuities. So what could be happening, and that is why it's important for you not to only ensure that you understand the normal TVM calculations that have been exposed to, but is how to use those calculations in an investment environment where all this information is given to you, and you've got to then say to your client which of those two investments are actually appropriate. Now, I've done a little bit of that in last year's exam and prep, and that's why I want you just to go through that. And I want you just to go through additional examples. I don't think your postgrad exam perhaps had enough. I'm not too sure. I'm trying to remember their past exams as well, but I can't recall. But go and see how you understand every single bit of product, which we're going to go into a little bit, and of course how that applies in terms of calculations. What calculations am I going to be doing where I can analyze and compare these investments and then obviously recommend. I think also one of the things we need to understand is what net asset value is and how to calculate that. That is important. It came up in now August, sorry, I think my February exam. I'm getting a bit confused between all these exams that I've prepped. It has come up there. One of the concerns was that very few people actually understood how to just calculate the net asset value of a unit. So make sure you understand how to do that. Where I could, I've given you a little bit of insight in terms of the formula of net present value of a particular investment, which is important, gives you the present value of cash inflows of a particular investment. So I want you to look at that. Take a look at the yield of a particular unit. You are going to be given fun fact sheets. Take a look at that as well. Please understand how to calculate, and a lot of this is also your cash flow calculations, the annual rate of return and internal rate of return. And then, of course, don't exclude, because I might be giving you a share portfolio this time around and not just fun fact sheets. In terms of collective investment schemes, sorry. I always talk about fun fact sheets in relation to collective investment schemes. I see share portfolios very differently. I just see share portfolios in the newspaper. But it could be any of those particular extracts. So understand how to go and value those shares. If one of the recommendations in terms of investments is to look for growths in certain companies, well, how am I going to determine which of those companies have got the best growth? What ratio am I going to be using? Also, don't forget your calculations in terms of dividend yields and reduction in yield. I think I've given you obviously some ideas there in terms of what can come in terms of the exam. Clearly what I've not done is given you too much calculations, and before I give you a break I want to explain that, because a lot of you are very used to my my presentation styles, the type of information that I actually do give you, and you'll notice that this time around there's been a slight change. Actually, I'm not going to call it a slight change, I'm going to call it a big change, and I'm going to just explain why. In the past, every time you see my material, I've done a full case study. I've worked on 2 case studies. Then what I've tried to do is I've tried to take the guidelines and I've built it into this case study, and then we've actually gone through the whole calculation. But what I've found in the past is that a lot of the delegates, a lot of you who are writing the exams, they seem to focus on these case studies that I've given you and only the calculations I've given you, etc. And you nearly go into these exams thinking that that's more or less what's going to come your way. And that doesn't always work. So it's a very sort of a fixed point of view, and I don't want that. I want you to look at wider than just what I am actually, or rather what I was actually trying to say in those case studies. So today is very different. I'm going through the guidelines, giving you ideas of what could be coming and how to tie it all together. I'm not giving you all the actual calculations, because I do believe that if you're going to do a little bit of research based on obviously what I think is coming into the exams, I think we're going to perhaps do a little better in our exams, because we are going to be doing a little bit more research. So that is sort of the stance that I'm taking in this preparation. So it is 11 o'clock. We're going to have our first little break. I'm also going to be looking at questions, but let's take a break. Let's make it 10 minutes, and then we'll see where we are, and I'll give you bigger breaks as we go along. So let's come back at 11:13. Enjoy the break. We are back after our little break, and I think what I would just like to do is, before we continue, is just mention that Paul has sent me two little bit of facts, and that was that, or rather that is that there has been some changes surrounding, there's been some legislation changes that impact collective investment schemes. So I've just asked Paul what he's picked up. It might not just be the collective investment schemes, that might be something else that he's making reference to. And then, of course, I'm hoping that he'll give me some feedback. If not, what I'll definitely do is go do a little bit of extra research to see what Paul is making reference to in terms of that legislation change. And then obviously also mention that the quotes in terms of your collective investment schemes, the quotes also now reflect both the TER at benchmark and costs at current level of performance. So thank you very much, Paul, for sharing that with us, and I will definitely come back to you in terms of those legislation changes. I'm quite curious about what it is that I actually missed out. And Maria, I see you asking some advice. I will address that at a little later stage, if you don't mind being just a little patient. So now we're going to go to this document, which I know I did definitely send through to you. It's a couple of pages. I hope you did read through it, because obviously some of these things I'm only going to be summarizing. A lot of these are actually very important from your exam guideline perspective, and I'll try excuse me, I'll try obviously as and when I go through these topics, try and tie it up to your exam guidelines so you know exactly where we are and what we have covered and have not covered. So I know a lot of you probably did your post-grad exam at the beginning, or rather towards the end of last year, and obviously this exam means that we are into our 2016-2017 tax changes, and it's going to be important to you because you'll notice that in your guidelines it talks about tax calculations, which means that you're going to need to understand all the tax changes that have taken place, and obviously the more pertinent ones. I don't think what they're going to do is ask you to do provisional tax and things like that, but clearly the more pertinent changes that have taken place is important. And what I've done in your first page is actually just summarized what has taken place. Notice, ladies and gents, that in your exam guidelines we are talking about medical aid and health insurance. And of course, although this has taken place quite a few years ago, I've also got to take cognizance of the fact that perhaps we do have students who are writing the board exam without necessarily having to go through the post-grad, which could mean that perhaps you have not done full tax calculations, etc. So bear with me. I'm not saying you guys don't know what you're talking about. I just have to take into account that we perhaps have very different type of students that are going to write the board exam. So those who may still be thinking that medical contributions and medical expenses are income tax deductions, that has changed some time back, I think about 4 or 5 years now, and instead of the deductions, what has been introduced is obviously credit rebates. So this is reducing tax payable and no longer reducing income tax, this is reducing tax payable and no longer reducing taxable income. So that's been a big difference. You will only get these medical aid credit rebates if you are contributing to a medical aid. If you are not contributing to a medical aid, then clearly you are not going to get these rebates. What you will be allowed is what we call our medical expenses rebate. So we've got 6 capital A rebates, which is only if you're on a medical aid, and 6 capital B rebates, and that's if you have medical expenses. But don't forget, these are monthly amounts, so if I am having to do anything on an annual basis, please ensure that you look at this from an annual point of view. And of course, if it's not a full year, if it's only 7 months, etc., then I can only have these credit rebates in terms of the months that I've actually paid for it. Then also, after you've done these medical credit rebates, when you are inside the expenses, please don't forget that we then look at 3 categories. So there are different formulas in terms of the expenses that are given, the credits that are given, and I look at people that are below the age of 65. Then I'm looking at people above the age of 65. Then, of course, what I have is a little category where there is a disabled member of the family, and in that point of view, it doesn't matter whether I'm below the age of 65 or above the age of 65. The fact that I have me, my spouse, or our children, if any of those are disabled, then the whole family is considered to be disabled, and irrespective of age, I'm allowed my formula as a disabled family. Important to realize that it's only me, my spouse, and our children. So if you've got your mother on the medical aid and your mother's disabled, you're not going to qualify as a disabled person. Although you are going to be allowed certain expenses to be included as an expense. Let me see if I can actually word that perhaps a little differently. There are certain disability expenses that you will be able to include if your dependents, anyone other than obviously spouse or children of yourself and or your spouse. I don't know how important that is going to be. I think in terms of medical aid and tax calculations, those sort of guidelines, I think understanding how medical credit rebates actually work and medical expenses work is going to be a little bit more important. Then, of course, please don't forget that last year was 20 over 40, 25 over 40, it is now 26 over 41. From a foreign dividend exemption, that's only because our tax rate obviously increased to 41%, so there has been a slight change. From a capital gains perspective, there have been huge changes with the exception of death exclusions, and you'll notice in your guidelines we talk about estate planning. There will always be estate planning, so it's important to understand that the death exclusion has remained, but all the other inclusions rates have actually increased. So important from that perspective. I actually forgot to switch off this. Then we're going to go through to our income tax framework, and I'm going to talk a little bit around this because the change really has been as a result of the retirement fund. Apologies for that. I've got a touch screen, so any bit of touch is so sensitive. Now notice from the 1st of March this year, we've had quite a few changes in terms of retirement funds. So some happened from the 1st of January 2016, and obviously some happened from March 2016. Either way, it's going to affect your exam because you are writing that exam now. So, in terms of retirement fund contributions, that has changed dramatically. There is still a little bit of confusion out there, and so Treasury has tried to clarify in the latest bill. So obviously you're not going to be tested on that. So we're just going to go according to what we know as it stands at this very moment. And because of this whole retirement fund deduction being changed, our framework, our income tax framework has changed slightly. So I still have the normal income and exemption, nothing has changed there. But what has changed is our format or our process in terms of our deductions. That is where the impact is taking place. So I'm just going to run through it slightly. I'm not saying that they're going to do a whole tax calculation, income tax calculation, but let's just make sure we know what it is we're talking about. So I'm still going to be looking at my general expenses and all other deductions that I'm allowed under Section 11 and any other section. I'm going to be bringing in my losses. I add my allowances. Now that is a small change because last year I couldn't take my allowances into account for retirement annuity deductions retirement annuity deductions. Now I'm adding my taxable allowances. What are my taxable allowances? Obviously the private component of my travel allowance, my entertainment allowance, and anything that I haven't used in terms of a uniform allowance, I think it is. But what is important is your travel allowance, obviously, and entertainment allowance. Then this part is questionable, and I'm going to just touch on it slightly, and that is, do I add my taxable capital gain at this point or don't I? There's a lot of us that say we added before and a lot of us that says we added afterwards. I don't think whichever route you go, I don't think it's going to be a train smash because we all understand that there's a little bit of misunderstanding in terms of the way the legislation reads now. It has been clarified in terms of our bill, but it's still a bill. I do not believe the examiners are going to be working on any proposals that have been made on this bill. If I am incorrect, I will double check with FPI after this. If I am incorrect, we will ensure that you are aware of it, okay? But at this stage, whether you actually add a capital gain before your retirement fund contribution or after, I don't think it's going to be a train smash. And then, of course, we're going to be doing this retirement fund contribution, which we're going to look at in a little bit more detail. Then I will be doing my donations that I make to public benefit organizations, and the rest is normal. This is where I made reference to above, your medical credit rebates and your medical expenses rebates, that you just need to understand how that works, I think, because we are talking about not only tax calculations but also medical aid. So that's important. Let's just look at this retirement fund contribution thing that has changed. Up until the 28th of February 2016, what did we have? We had retirement funding income and non-retirement funding income. That's been done away with totally. It's still perhaps a terminology what has happened now is end of the year. Now, of course, on a monthly basis, it works different. That's not what we're going to be concentrating on. At the end of the year, when we're doing our final assessment, what you're going to do is you're going to take all those fringe benefits, so all the contributions made by the employer on your behalf, plus your own contributions, you're going to add that up, and that total figure you're going to say, that total figure, which is the contributions collectively made by yourself and your employer, What can I deduct? And it talks about the lesser of 27.5% of, which we're going to look at now, or 350. So which one is less, 350 or the greater of 27.5% of remuneration or taxable income? So I think to make it easier, I'll start off by saying, what is the greater amount? Is it my remuneration or is it my taxable income? So which of those two amounts is actually the greater? I'm going to take the greater amount, be it remuneration or taxable income, and I'm going to work out what 27.5% of that greater amount actually is. Then I'm going to look at that result and I'm going to compare which one is smaller. Is 350 smaller or is 27.5% smaller? That is the deduction that I'm allowed, but clearly limited to the contribution that I actually make. So that is the new formula from the 1st of March 2016 going forward. And it sounds that very simple, but what is inside remuneration and what is inside taxable income? So this is where, if I go back to this little framework, is where is taxable income in this equation? I am saying that at this stage, the way I've been reading and the way a lot of people have been telling me what their interpretation is taxable income is after I've added taxable capital gains. So I've done this whole formula up front, gross income, exemptions, deductions. I've added taxable capital gain, not a capital gain, a taxable capital gain. Now I'm going to work whether that income there is actually greater than remuneration. What is remuneration? Remuneration, did I give this all to you? No. Remuneration is clearly everything that my employer pays me. So I have to have an employer-employee relationship, or it could be just a contract. Be careful, because contract is also part of remuneration. So everything that I get paid as a result of some form of employer-employee relationship, and that will include my salary, commission, my fringe benefits, so fringe benefits to retirement funds, fringe benefits to medical aid, company car fringe benefits. It will include any form of annuity that is getting paid by my employer. But what these amounts do not include, for the calculation of retirement funds is lump sums from retirement, lump sums from withdrawals, and severance benefit. So you leave those lump sums out, look at which is the higher, taxable income or remuneration. You take 27.5% of the higher of those two amounts, compare that to 350, which one is lower, and then look at the actual contributions you made, limited to those contributions. So that is the change that has taken place here. I just want to see if I've given you an example there. I want to quickly see if I've touched on it or not. No, not at this stage. There are a couple of things that are taking place, and I'm not too sure if I've put it under retirement or estate planning, but we will definitely cover it. So I've given you some examples there as well, and obviously the important thing is the way the legislation is written at this stage. It reads as if you cannot take any previously disallowed contributions into account, and that was not the intention. They want the rollover to continue. So the rollover does continue. The only thing that it seems is as if they were not taking any contributions into account that were disallowed up until the 1st of March 2016, and they say no, that is definitely not what their intention was. All previously disallowed contributions will be continued over and over and over until you have a particular event. So I've given you a little example there. I hope that example does help. It's nice and simple. I can't see it getting any more complicated than that. But of course, there are some changes that have been deferred, because not everything came in the 1st of March 2016. And what has been deferred, which is important, so when there are recommendations in terms of any form of retirement planning, in terms of products, etc., then you've got to understand that from a Provident Fund point of view, the annuitization part has been deferred until March 2018. What does that mean? That means that anyone that's in a Provident Fund at this stage or goes into a Provident Fund will at retirement still be able to take 100% of their funds out. There's no obligation of investing 2/3 of their amount into an annuity. But remember, this has also impacted Section 10 capital C, which is an exemption against compulsory annuity. So let's just quickly draw this whole thing, that what happens is, obviously, I'm going to go back to pension funds, because the only deferral clearly has been Provident funds, because everything else has to be annuitized. But what happens is, when I retire from a pension fund, you know that 1/3 I can take cash, the other 2/3 have to be invested into some form of annuity that's going to generate whatever amount of money on an annual basis. So this is what we call a compulsory annuity. I don't have a choice but to go in there. But what happens is this 1/3 has to be taxed according to the retirement tax tables. Note that. Part of your tax calculations also includes lump sum taxation, ladies and gents. We're going to touch on it a little bit later on, but I'm touching on it now as well. So repetition, repetition. So this 1/3 is going to be a lump sum that's going to have to be taxed according to the retirement tax tables, or lump sum tax tables. Now notice, and we still seem to get very confused with this, notice that before I take this amount and tax it in our tax tables, which has got that terrible 500, is it 500 or 550? I cannot remember now. That's very bad of me. That 500,000 tax-free component, before it even goes here, I'm allowed certain deductions against this lump sum, and one of those deductions are my previously disallowed contributions. So all those RA amounts, pension amounts, provident amounts, etc., have been previously disallowed. Of course, you're not going to have too many provident contributions that have been previously disallowed because they were not deductible before. But the ones that you have, you carry over. Now, if your 1/3 amount, let's say your 1/3 amount was 400,000, okay? That is the amount I'm taking cash. I understand that that 400,000 would be tax-free, but I'm not even looking at that. Of that 400,000, I am saying that I have 600,000 previously disallowed contributions. Can you understand that clearly I have nothing to be taxed? So my 500,000 is still sitting there for another event, for that to be utilized. But I have 400,000, 600 disallowed, nothing is going to be taxed, but I have 200,000 contributions that I did not use against this lump sum deduction. This becomes what we call unused deductions. Section 10 capital C says the following. When I have unused deductions and I have a compulsory annuity, at the end of the year of assessment, SARS is going to say, do I have unused deductions? Yes, I do. I'm going to exempt my compulsory annuity. Clearly, I've only received 100, so I can only exempt 100, which means in that year, my annuity will be generating no income to be taxed. And now I've got 100,000 that is left over. Next year, I'm going to generate an annuity, let's say, of 150,000 because it's increased with inflation. SARS says, do you have unused contributions? Yes, we do. We've got 100,000 unused contributions, which means all I'm going to be taxing in that particular year of assessment is 50,000. And off we go, on we go, until obviously I have no more unused deductions. So 10 capital C says that I am allowed to take a look at all my unused contributions as a result of previously disallowed contributions, and I can exempt compulsory annuities with those amounts. But what you cannot do, it has been deferred until 1st of March 2018. So what you cannot do is use that 200,000 as I have in my example against an annuity that has a source of a provident fund. Now, a lot of you are going to go, but why would a provident fund have a compulsory annuity? Well, although a provident fund does not have the 2/3 obligations, you can, if you want to, take any amount of your provident fund. You can take the 1/3, the 2/3, the 3/3, the whole amount, the quarter amount, doesn't matter. You can take any of that amount and you can invest it into a linked annuity or to a living annuity, which is termed a compulsory annuity. But unfortunately, if that compulsory annuity, if the source of that compulsory annuity was a provident fund, then Section 10 capital C does not apply to that provident fund because all the changes have been deferred to the 1st of March 2015. So when you are doing any form of maybe a lump sum taxations, any form of income tax calculation, remember your Section 10C is important because that has been deferred. Then, of course, we all know that our de minimis amount on our 2/3 have actually increased to 24,700. So on retirement, and this is only on retirement because clearly when there is death and when there is resignation, I can take my full amount. I'm not limited to 1/3, 2/3. I can take everything. So clearly from my annuitization amount now, 24,700 says when I retire and my total amount in that fund is below that amount, then I'm not obligated to my 1/3 and 2/3. I can take the whole amount as cash. Of course, that will be taxed according to the retirement tax tables, lump sum tax tables. It doesn't mean that because it's below 24,700 that all of a sudden it actually escapes income retirement tax tables. It does not do that. From an estate duty perspective, we've had a very, very significant change which impacts estate planning. You ladies and gents must please note this is very important. It impacts estate planning, which means that your client will be paying extra estate duty, I think unnecessary, on a fictitious amount. So not only do you have to go take a look at how it increases estate duty that now is all of a sudden payable, you also have to go and take a look at whether there is liquidity in the estate because there is this fictitious amount that comes in which increases your duty. So let's go take a look at what that is. And it's not under deemed property. It's not under deemed property. Why did I say under deemed property? I think it's under property. Okay, that is a little irrelevant at this stage because you just need to know the whole principles, but I'm going to double check that because I think it's under property of estate, of your estate duty calculation, not under deemed property. Notice what we've done is financial planners have gone to a client. The client is not a very young client. Let's just call him 70 years old. If there's anyone who's 70 years old, please forgive me. But at 70 years old, clearly you don't need to do retirement planning. Hopefully you are already in retirement planning. But what can happen clearly is that you have this huge estate. And immediately on death, you're going to have a huge estate duty problem. So what we've been doing in the past is we have taken some of that liquidity and we've put it into a retirement annuity. Why? Because clearly the minute money is shifted into a retirement annuity or a retirement fund, some people were using pension funds or provident funds, then that amount is not estate dutiable. So if you had a 20 million rand estate, on death, 20% of 20 million rand is what you would have to pay from a duty perspective. But if I had to move 20 million rand into a retirement product, I immediately saved you 20% of that amount because that retirement fund is not estate dutiable. It would also not implicate or be inconvenient for your beneficiaries because if you die on death, that full 20% are back 12:30. So what we're going to do is from now on we're going to go right through to 2 o'clock. no more breaks. Make sure that we can cover as much as possible. There have been some questions. I've got to apologize. I notice that some of your questions are directed as and when I'm saying something, and I don't always have time to go back to see as and when a question pops up, because Kirsty's been kind enough to copy and paste them through to me, so I don't always, it's very difficult to just get those questions as and when they come up and I'll answer. So you'll notice a lot of times I'll go back to you and go, sorry, will you explain what you're actually referring to? But if I still don't address it, please do email me, and I must admit I'm loving you bunch. You are definitely on the ball, because during tea break I quickly looked at my emails and wow, I have a whole lot of you who have already emailed me. And I think that's fantastic. Thank you very much. I really don't mind. But a concern is that it seems like a lot of you have not received these notes that I've sent through. I'm going to double check with Fatima and that, and Amanda, in terms of perhaps resending it. I'm not the one who actually sends it out. It is FPR who does that on my behalf, and it was sent out last week already. So I'm going to double check that we resend this, and I think what I'm going to try and do is make sure that all other notes that I've worked on are ready, so that Amanda and Fatima can send this out to you as soon as is possible. If you then have not received anything, I don't have a problem if you come back to me, but of course what I'll do is I'll always refer you to FPI as well, because they need to know if there's any particular problems. So I do apologize for those who do not have notes, but if you are just listening to me, and also the recording will become available as well, so then maybe what you can do is replay and just take a look at where I've made certain notes. And then there are some questions that have popped up that I just want to explain. The one question I think came from Paul, that wanted to know about this de minimis amount. Remember, in terms of changes, all your retirement funds have got a minimum amount, or rather maximum amount, of 24,500. That is when you retire and the total amount of your fund is 24,500 or below, then you can take the whole amount in cash instead of being obligated to 1/3 and 2/3. And the question is, does that apply to each retirement fund? Now, this is a very interesting question that pops up everywhere I go. If you look at the Income Tax Act that talks about this de minimis amount, it does not make reference to an administrator, it does not make reference to fund. It talks about in that retirement annuity, in that pension fund, in that provident fund. So it's actually within the definition of a particular product. But what you've got to understand is, when you're looking at insurers, so if you're looking at the actual administrator, so the Act reads, in that pension fund is a 24,500, in that RA is a 24,500. So it nearly reads that it is per policy or per product. But one thing you must understand is, in the insurer gets what we call perhaps one approved fund, one approved registration with the receiver of revenue. So all the funds, providents, retirement duties, etc. get plugged under this, let's call it an umbrella, under this one fund. So the way the insurers look at it is that when you apply for retirement, they will look at your pension fund value, your retirement annuity value, 2, 3, 4 retirement annuity values, and they aggregate that and say, does the total of all these little roles that you play under this one fund, does that go, is that below 24,500? And if it is, then they will cash it out. If it's not, you are obligated. So yes, Paul, if I have a retirement annuity, let's say with Liberty Life, and that retirement annuity is only 100,000, but I'm also a member of a pension fund that is under Liberty's administration, it's all under one fund, they will add that together, and if that exceeds to 4,750, then unfortunately I'm pretty stuck. And then the other question was by Conrad, where Conrad says, in case of withdrawal of the whole amount, which is below 24,500, is this still set off against previously disallowed contributions? So, Conrad, what I'm thinking you're saying here, and you're going to guide me, is let's say, for instance, I go and take out my, I'm retiring, and the amount is, let's say, 200,000. Okay, so the amount is 200,000. When I take this 200,000 out, this 200,000 still has to be applied to the tax tables. But before I apply the tax tables, I still have to go and deduct all previously disallowed contributions against that 200,000. So if I have previously disallowed contributions of only 50,000, then I've got 150 left. This 150,000 goes into my tax tables. It is within the first 500,000, so it won't attract any tax, but you must understand my 500,000 there, in a way, when I aggregate amounts, has actually been reduced by that 150,000. But let's say, for instance, that the contributions I have that have been previously disallowed are 300,000. Then, of course, my 200,000, there will be no tax that has to be paid, so I haven't touched the tax tables at all. And what I will have is I will have 100,000 that is left over for me to for me to utilize against compulsory annuities. Conrad, I think that's the question that you asked me. If not, I'm quickly taking a look because I wanted to address that before I move forward. All the others I have kind of said to you, please explain to me a little bit where you're coming from, because obviously those questions were done a little differently when I was talking. I do know that someone's replied and I can't pick up that reply at all. So for the benefit of time, I'm going to leave this and I will come back because I know Kirsty sent me something and I can't for some reason pick it up. Okay, perfect. And anything, again, like I've said, anything that I haven't addressed, you are now very used to my email address, so by all means, keep using it, and I will get through to you in terms of response. Okay, so let's touch on retirement products. You know, I know it is, yeah, it forms part of your product guideline in general, and so why am I emphasizing retirement products in particular? I don't know, maybe because it's got nothing to do with your exam, but all I'm doing here, ladies and gents, is I'm going through past exam trends, okay? And past exam trends, there have always been some difficulty in understanding in terms of what products can I enter into for retirement purposes and what products can I utilize after retirement purposes. So our sort of timeline here is pre-retirement. So I'm saving until I'm saving for my retirement age of 60. Now I have hit 60, I'm going into my retirement. What products can I use afterwards? And we seem to be mixing these products up. I'm not sure why, but we do seem to be mixing them up. So what you've got to understand is the products for me to save for my retirement age is exactly that, are products where I'm going to build up capital. These products do not generate income whatsoever. It's just a savings component. It's money that I want to put away so that when I turn 60, I have this pot available for me to actually utilize. Now that I have reached 60, what do I actually want to do? Ideally, what I want to do is I want to receive some form of pension. And pension, we can also call it some form of annuity. So I want some form of income. So I've got to look at products that are going to generate income. So what would I be using? What type of products would I be using to save? Well, there are retirement annuities, there are pension funds, there are provident funds, there are tax-free savings account. I can be looking at unit trust, I can look at a share portfolio, I can look at a plain investment. Can you see, I've got some of us, and here I'm just trying to explain something. Doesn't mean it's going to be in the exam. The examiner might want to even shoot me for saying this. But some of us might want to invest in Persian carpets because we believe Persian carpets are going to give a far greater return than any other product out there. That is a savings component. I might not necessarily agree with it, but that is a savings component. So any product where it helps you build capital so that when you wake up at the age of 60, there's this huge pot of money that you can use. Now that you've got this huge pot of money that you can use, we say, what products are there that I can utilize to generate an income? Now, depending on the product I've used before, there could be regulations or limitations in terms of the type of products I go into afterwards. So if I use a retirement product, i.e. retirement annuity pension fund, provident fund, then of course I have this potential 1/3 and 2/3 rule. And then I've got to do it into a compulsory annuity. If I come from a, let's say, unit trust or share portfolio, I don't necessarily have to get out of that particular platform. I can stay in that platform and I can draw from capital. There will be capital gains tax, but I can draw from capital. So depending on the type of platform I am on before, I can continue on that particular platform. Or perhaps I am in, let's say, a tax-free savings, or I am in a normal bank account, whatever you feel is ideal for you. I can go and look at something like a voluntary annuity, because a voluntary annuity will still provide some form of income, and I've got the advantage of the fact that the capital component is actually tax-free. So that is what you've got to go and look at, ladies and gents, is go and take a look at the type of products I'm allowed for capital wealth, for retirement purposes, and once I've hit retirement, what products are available for me to go into that is going to generate some form of income. Also, don't forget what is important is depending on the type of product that you have recommended, I clearly have certain limitations. So if I go into retirement funding products, I've got Regulation 28 that becomes applicable, which ties up with all the other aspects of your guideline. I also have this Section 37C, which is very important, because note what they've also spoken about here. They've spoken about divorce. They spoke about divorce here, and there's divorce with something. Why can't I pick it up? Heavens, all of a sudden I can't pick it up. Something's wrong with my eyes. Okay, oh, here it is. Understanding divorces. Divorce Act, pension fund. We're going to go into that. But pension fund, if I'm in a retirement fund, pension fund becomes important because under Section 37, capital D, there is something about deductions for divorce purposes. So, of course, if I'm going to go and recommend to my client they must go into a retirement fund product for retirement purposes, then I've got to understand that if there's a divorce ideally not pre, but if there's a divorce while I'm a member, etc., there's going to have an impact in terms of a deduction for retirement purposes. So that is important also to look at. So I've given you in my notes the type of products that perhaps you can look into, etc., where Regulation 28 is applicable and not applicable. So I have actually touched a little bit on some of those products, and you must understand where it is protected from creditors. You must understand the type of fund. Does it attract tax? Does it not attract tax? Capital gains, for instance, if you recommend the share portfolio, and that is what you're going to be drawing from on retirement, then you must understand I've got capital gains tax implications every time I dispose of a share or of a unit. But then again, if I invest in a living annuity, a linked annuity, then I must understand clearly that the income that comes out of that is going to be income tax according to my marginal tax rate. But then, again, I have Section 10 capital C. Can you see how the whole thing ties up and why you need to know so much information to just be able to put a plan together? And that is going to be the skills you are going to show us when you do this exam. So before I go into health products, a question has popped up, and I think there's been a lot of questions in terms of lump sum taxations and retirement funds, and I want to make sure we're all very comfortable with that, so I just want to go look at that very quickly. I've got Google. Hello, Google. It says, hi, Carmen. Is it 24/7 500 or below, or is it? It's 24/7 500 or below. So if I'm 24/7 501 cent, I'm out of it. But if I'm 24/7 500, I'm still okay. So I hope that clarified that, Google. All right, health products. So what I'm trying to do is I'm trying to tie health products with medical aid and health insurance, because those are two sort of little components in your guidelines. Your health products falls under products. So there sounds nearly like as if we're looking at insurance type, long-term and short-term insurance type products, and obviously medical aid, which is under the Medical Aid Schemes Act, and then again they've spoken about health insurance. So I think one of the things I just want to touch on first is, remember, health insurance also comes in the form of events such as disability insurance, rare disease insurance, your travel emergency insurance. All that is actually health insurance. Although we've been speaking about it, or rather I made reference to it under risk product, we can also see that as health insurance. So it's not just, how would I put it? Sometimes when we talk about health insurance, we just kind of see an event, you know, where I've landed up in a hospital, etc. I suppose if you are disabled, if you have a rare disease, you also land up in a hospital. So that is not correct for me to try and explain it from that perspective. But I think when we talk health, we nearly like very, we tend to focus on medical aid, medical insurance, etc. So there is other stuff, but let's just look at this, these health products. So you really have two types of products, if I want to sort of summarize that. I've got products that will fall under the Long-Term or Short-Term Insurance Act. Then I've got products that go under the Medical Schemes Act. They have different objectives. It's different objectives. Although, of course, I'm going to pay out money one way or the other for the fact that something has happened to you, the objective is slightly different. So when it comes to health insurance, we look at a health event. All right? And you must understand, in terms of health insurance, what we do is we actually pay out an insured amount. We don't pay out expenses, we pay out an insured amount. So, dear sir, you had a heart attack, let's look at the rating of that heart attack according to the insured amounts. Oh, you know what, we reckon that a heart attack is worth 500,000, so we're going to pay out 500,000. Whether your expenses were actually 100,000 or whether your expenses were $1 million, it doesn't matter. That's the sum that's been insured according to our books, and that's what we're going to pay out. So it is based on a health event paid out according to a sum assured. And because it is under the Long-Term Insurance Act, we can actually have underwriting, and we can actually rate you according to your health. So we can decline you, we can exclude certain events, we can even increase your premium. So because it's under the long-term or short-term, we are allowed to decide how we're going to run it. Now you must understand there are very few products out there that can be sold under the Long-Term Insurance Act. The products that are currently in place were in place before the whole demarcation rule took place, I think already quite a while back, I think 2006, 2007, somewhere there. So we can't really sell any new health products or health insurance under the Long-Term Insurance Act. Of course, there are still some under the Short-Term Insurance Act, and you obviously have heard things like GAP, your GAP cover. That's under your Short-Term Insurance Act, and that GAP cover is really to make up, here's what it cost me, here's what the medical aid is paying, and it's to make up that that gap between what the provider has charged and what the medical aid actually has paid out. Now, if we compare that to a product under the Medical Aid Schemes Act, that is very different, because what we do here, we base it on the fact that you have obtained some form of health services. And we don't look at whether it was a heart attack or not. What we do is we look at the actual expenses for that service you obtained for that health event, which is very, very different to these two. Also with health insurance, more often than not, the insurance company actually pays the individual. We don't always pay the provider. I know there are little forms where we say we can pay the provider, etc. But this is actually money that we paid to the insured and not to the provider. Where the medical aid pays the provider, they will pay the hospital, etc. They are not there to pay the insured, or rather the principal member of that fund. What they're also not allowed to do is they're not allowed to do any form of underwriting, and there is no risk rating here at all. We cannot decline you. The medical aid will accept you. Of course, what the medical aid has is they have some form of protection under the Medical Aid Act, and mainly under Section 29 capital A, which is your waiting periods, and of course your late joiner penalties. I can't think of the section of the Act at the moment, Medical Aid Schemes Act, for late joiner penalties. That is a protection for the medical aid because of the fact that I cannot decline you whatsoever. So the waiting periods that kick in is really to protect the medical aid, because you might decide you only want to join a medical aid because you've just recently had a heart attack and wake up, this is now going to be an expense, so let's run to a medical aid so that they can start paying. Well, there's going to be waiting periods that apply, etc. But none of those waiting periods, specifically your condition-specific periods, cannot exceed 12 months. So, but they have at least 1 year's worth of protection. And then the other protection they have is what we call the late joiner penalties. So if you decide to join a medical aid after the age of 35, whether you have credible coverage or not credible coverage, because obviously we're going to take a look at that as well. And then of course what we're going to do is we're going to penalize you by adding a certain percentage onto your contributions, because we all know what we are like. While I'm young and healthy, why do I have to fund anything? Especially if I'm told that through a medical aid I am funding the sick and the elderly. So why do I want to go into something like that? So what am I going to do? I'm going to wait until I'm old and sick before I get onto the medical aid. So because you've joined the medical aid late, we are going to penalize you by increasing those contributions. So can you see, and from a health insurance point of view, all they need to do is just say, sorry, we're going to decline you, or we're not going to cover that particular condition, etc. So very, very different type of setups. Very, very different types of products. So go understand that a little bit. For those of you who perhaps are not involved in medical aid or medical insurance whatsoever, and you want to understand a little bit more, one thing I do recommend, and this is not an FPI recommendation, so it is not important to go read, ladies and gents. I'm just saying, in case you have the time and you do want to know a little bit more, it is quite a big book. It has got just over 400 pages, so only if you have time, and that's the Healthcare in South Africa, written by Liz Still. Very, very interesting book to read. So let's just again touch on medical aid, because what else would they be asking you in terms of medical aid? They have sort of said medical aid and health insurance, which tells me that there is a comparison of the two. They've spoken again about health products and the products, so maybe their focus is a little bit more on health insurance than it is medical aid. But this is the first time I've seen medical aid popping up. So go understand how the composition of medical aid benefits. I think that's important. But I think perhaps let's just also look at, you know, if you come and see me and I want to join a medical aid, what must I look out for? What is it that you're going to be looking out for? for the client's best interest. Now, I know what we as financial planners will probably do. We kind of go, oh, but I'm only contracted to sell Discovery Health, so I'm going to be recommending Discovery Health. Maybe someone else comes along and says, well, I do Momentum and I do Discovery, and then we go, well, which is the cheaper of the two? Okay, so I know that we sort of focus in terms of how we work and our experience perhaps, our biases perhaps, and obviously what we are contracted to. But I think in the exam, obviously, you're going to have to look beyond that. Go, how do I select the best medical aid provider and or option for my client? So all I've done, and I've just sort of come up with a few. I think what you've got to go do is you've got to go investigate a little bit more, because you might actually have far more other criteria to look at than the ones that I've just put here. I've just done what I have known over the years, and of course I'm not necessarily the greatest health broker there is, so by all means go and do a little bit of research. But I go, well, firstly, perhaps one of the things I should be looking at is these solvency levels, because we all know that every single medical aid provider out there, and remember these solvency levels are per option. So if we look at, gee, I don't know all the names of all these medical aids out there, but I'm just going to think of Liberty, because Liberty has Platinum Focus, for instance. And then that's the end of that. I don't remember all the other parts that they have. But every medical aid provider, so you're looking at Liberty, you're looking at Discovery Health, you're looking at Momentum Health, what they have is they have lots of options. So you have a provider here, and then they've got a lot of options. This one could be comprehensive, this can be half comprehensive, this one can be, let's say, Netcare or Network, this one can be called Gold, etc. Under each of these, we have different benefit options. So this comprehensive might have 300 chronic conditions that we're going to cover, where perhaps this one right at the bottom here will only have 35 chronic conditions that will be offered. This one might have international emergency, this one might have only local emergency. And then we have combinations. This one might have a hospital component as well as a threshold component as well as a medical savings component. This one might only have a hospital component. This one might only have a hospital component with a savings and no thresholds. So can you see each medical scheme provider or medical aid provider will have various options under their umbrella. And the solvency ratios are actually per option and not necessarily per provider. So it's not Discovery Health that has to meet these solvency levels. It's Discovery Health Comprehensive Plan, Discovery Health Gold Plan, Discovery Health Netcare Plan. They have to meet those solvency ratios, each of those. So I want to first see that the medical aid provider I'm going to and the options that they have actually do meet these solvency ratios that they have to have. Okay, so that's one. And then, of course, what I've got to do second, I think second, is what are the options and or benefits they are giving me. If I have someone who probably suffers from, or if my family does suffer from heart attacks, strokes, etc., cancer, etc., then clearly I want to look at a benefit or an option that provides me with those benefits. So would I go to a plan that is only a hospital plan and nothing else? I don't know. Maybe I want a medical savings account to it. But what if this plan only covers 35 conditions where this plan covers 300 conditions? Would I not want to look at those conditions and say, do these conditions actually cover heart attack, stroke, etc.? It might not. I know there's PMBs. Of course, you've got to also look at PMBs, but PMBs are only for a specific period. So I think we've got to look at those particular options and the benefits in those options. I think, to me, the last would be premiums and affordability. You know, This is a difficult one to say. So again, I'm so grateful that you're going to have the facts in front of you and that you're writing an exam. Because of course, the first thing the client is going to say to you is the client's going to say, I can only afford 1,000 Rand. And 1,000 Rand is only going to give them this very small little plan. Of course, one of the things that is allowed in terms of rating here is income. Okay, my premium cannot be based on your age, your gender, your health, etc. But one of the things the medical aids are allowed to do is provide an option based on your income. So we do have that. Okay, so go and do a little bit of investigation. But the difficulty is where your client says, I have 1,000 Rand only, and that 1,000 Rand can only give him that particular option when what the client truly needs is this particular option, which is fine. I understand that you're going to have to balance it. But are we happy with the solvency ratios of that fund? Are we happy that at least we covered with quite a bit of those benefits? Also, take a look at, and you'll notice that in this guidelines, we're talking about financial statements, cash flows, budgeting, business insurance. Why did I pick up financial statements here somewhere? Somewhere, we're going to get there. So let's look at some of those financial statements and look at operational and total performance of that particular scheme. Okay, and then one that I always found interesting, which comes up on a regular basis, is the more those trustees are getting paid in terms of remuneration, perhaps the less it's getting managed. Look, I'm not saying that that is the case, all right? So please don't go into the exam and say, yeah, but Carmen said. Go and do your own research, ladies and gents. I'm bringing in some things for you to actually consider. So that's medical aid and health insurance. I'm just going to quickly pop and take a look at this question. And it asks, do I think they will test the changes in tax deduction of contributions to income protection product? Google, who knows? So let's just quickly touch on that. Income protection products, this has actually got nothing to do with medical aid at this stage. But you know that you have income replacements. And up until 2013, actually, 2014, contributions to income protection was a Section 11A general deduction, but it has stopped. You have, yeah, it was actually 2014. You are not able to deduct income tax protection. You're not able to deduct contributions made to an income protector anymore. It is still a fringe benefit if your employer is contributing on your behalf, but it's no longer a tax deduction. Divorce. If you take a look at your guidelines, it talks about divorce and the Pension Fund Act, etc., etc. So, of course, what you've got to do is you've got to look at the whole divorce situation and say what legislation will impact a divorce. So, of course, your Divorce Act will, your Pension Fund Act will, income tax, because perhaps I'm not a spouse anymore, but not only that, what about maintenance that gets paid out? What about the lump sum that gets paid out? And I thought, I did put it here, because I'm going to just quickly touch on it and I'll go back. Don't forget your law of succession. That becomes important because there is a little section in terms of your Testate Succession Act, which talks about when you divorce, how long a will is valid for in terms of nomination of your spouse. And of course, a divorce also takes precedent in terms of estate plan, because am I spouse, am I not spouse? So you can see there's quite a bit of legislation that impacts divorce. But because they sort of kind of went Divorce Act, Pension Fund Act, and then went etc. You see how I'm reading your guidelines. I kind of go, well, let's just quickly look at the Divorce Act, what it says. Let's look at the pension fund. And then they still talk about matrimonial property regimes. And you know, matrimonial property regimes, the way you are married, actually has an impact in terms of a divorce and a potential claim under the Pension Fund Act. So I'm reading that all together. So first, let's start off making sure that we understand that from the 13th of September 2007, clean break principle was introduced. What is clean break principle? Well, what happened prior to September 2007 was there was a divorce and the divorce decree had an award against the pension fund, then what would happen is the pension fund would put the money aside. Let's say, for instance, it was 100,000. The pension fund would put that 100,000 aside, and that 100,000 would stay in a little very black dark pot, because it would not even participate in growth, because a non-member cannot be a member of a fund, clearly. And you would wait until your spouse died, retired, resigned, for you to get that 100,000. And divorce, the way we know divorce is, when there's a divorce, everybody hates one another. So if you were waiting for your 100,000, trust me, your spouse would wait until he died, or she died, or retired before you could get your 100,000, which meant 20, 30 years down the line, that 100,000 you might as well not even claim it, because what would it buy you? Maybe not even a movie ticket. So through case law, what happened was, clean break principle was introduced, which says the minute you are divorced and there is that degree against a fund, thou shalt claim your money and the fund will pay it out. That also obviously includes any money, any claims that were currently sitting with the funds. You could go and claim it immediately, and that's what we call the clean break principle. Now, under Section 37D, it talks about the whole claim process and payment, and I think that's important because 37D talks about if there is a claim that takes place, I'm allowed to make these deductions against the member's interest, and it gives you a particular time frame. Once the member advises the fund, how many days does the fund have to then go back and ask the member to elect? How many days does the member have to then tell the fund what to do with the money? And then how quickly must the fund pay out before interest starts accumulating, etc. That is important to look at, okay? And there's a lump sum amount. There's also a maintenance that can be placed against the fund, and those have different tax implications. We're going to touch on it just briefly. Then, in terms of the Divorce Act, Section 77 to me is very important. There are other sections I think you can look at, but Section 77 is important because look what it says. It says, a pension interest of a spouse is deemed to be part of his or her assets in the determination of the patrimonial benefits to which the parties to a divorce action may be entitled. So you can claim a pension, but it does not extend to a marriage entered into in terms of an antenuptial contract excluding the accrual system. So, of course, I can go attack the fund if I'm married in community of property. I can go attack the fund if I'm married out of community of property with the accrual system. I cannot go and attack the fund if I'm married without the accrual system. And then it talks about a marriage. So, of course, if I am in a long-term relationship, I cannot attack the fund from a divorce perspective. I'm not talking about Section 37C in terms of death, very different. And if I'm in terms of tenets of religion, I cannot go and attack a fund in terms of a, well, divorce. There's no such thing as a divorce, but you know what I mean, in terms of separation. So that is an important section to read in terms of the Divorce Act. And then, of course, you go and tie it up with Section 37D in terms of the Pension Fund Act. And remember, please, death is very different to divorce, different rules for divorce and in terms of claiming against the fund and payment, and very different in terms of death, in terms of claiming and distribution. In terms of the Income Tax Act, I'm just mentioning these acts. In terms of the Income Tax Act, of course, if the non-member claims a lump sum, if it's a lump sum, then of course that lump sum will be taxed according to lump sum taxation, which is going to be a withdrawal. All right, unless obviously I transfer it over to and approved. So if I transfer to the RA or to a preservation fund, etc., then there will be no tax. But if a non-member draws it from a tax perspective, from a lump sum perspective, there will be taxation. If there is maintenance that has to be paid, i.e. it's not a lump sum payment that has to be made, it's a regular annuity, then of course it is deemed to have accrued to the member, which means that the person, the member of the fund that has to pay the maintenance, they will be paying tax. There's tax on tax there, but the recipient of that maintenance will not be paying tax because it is exempt. So all this is obviously important in terms of planning. Marital regimes come into play, etc., because you have to ensure that there is liquidity in the estate. If it's a divorce that if there's a divorce that is not an award attached to a pension fund, I've got to look at retirement planning all over again, because clearly my funds are depleting. So can you see there's quite a bit of impact, but don't forget all this is because of the fact that clean break principle applies, and clean break principle applies to both your public and private sector in terms of the funds. Wow, let's go into marital regimes, but because I'm not taking a break anymore, I want to quickly look at these questions and see. It's actually from the 1st of March 2016. I'm not too sure what is from the 1st of March 2016. If you can guide me there quickly, I apologize. I don't know if you're talking clean break principle. I don't know if you're talking taxation. I'm not too sure what you're talking about. So if you could just help me out there, Rudolph, I'd appreciate it. Then I will just clarify what I actually said. Marital regimes and estate planning. So I think we all know what our marital regimes are. I've got all under the Marriage Act. Okay, I think I think that question was just clarified, so let me just quickly, no, income protection, Rudolph, wasn't 1st of March 2016. So let's just go back. Google asked a question earlier on about, are income protections now deductible or not deductible? Remember, income contributions to income protections were deductible under Section 11A. That got stopped. Rudolph says no, the income protection actually got stopped from the 1st of March 2016. Sorry, Rudolph, I'm going to very comfortably say that you are incorrect from that perspective. It was 1st of March 2014, and I'll tell you why I recall that, because I did a seminar just the other day where I got confused with my dates. I actually thought it was 1st of March 2015, and the delegates made reference to my notes and said, no, 1st of March 2014. But I'm going to go through the business assurance notes that I sent through to you. I think I do have it there. I'm going to double check. But just to make sure, everybody, just make sure you are comfortable. I will double check that date as well. Okay, thanks, Rudolph. I will double check that date. Okay, so from a marital regime and estate planning perspective, remember all under the Marriage Act. Under the Marriage Act, I'm deemed to be automatically married in community of property. So automatically in community of property unless I ask otherwise. Then I will be married out of community of property with the accrual unless I specifically ask to have accrual excluded. Okay, so those are our marital regimes. Automatically in community property unless I ask for the other community property with the accrual, unless I specifically exclude the accrual. Now, how does this relate to estate planning? Of course, it does relate in terms of if I'm married in community property, I must understand 50% is automatically my marital right, so I can only bequeath half of my estate, and then I've got to understand whether I have liquidity not only for the one half of the estate, I have to have liquidity for both joint, because in community of property, jointly and severally liable for that debt. And you don't want to leave the surviving spouse in a situation where they're going to have to sell those assets to actually cover that debt. I think that is unfair from that perspective. So that's your estate plan impact. In terms of the accrual, and we're going to look just a little bit in terms of the format that we're going to be using for accrual calculation, and again make reference to my case studies that I've sent through to you, because there's a nice accrual calculation that I've given you as well, including life insurance policies. I think that's important to understand before you go into the exam. But then, of course, from an accrual perspective, what happens from an estate plan? Accrual claim is my right. So that accrual claim is like a creditor, and it will be distributed, or rather not distributed, it will be paid to the surviving spouse before any bequests that are made. So an accrual claim has the same ranking as a creditor against the estate. So that is very important from a planning perspective, okay? And then, of course, if I have no accrual, so I'm married out of community property, excluding the accrual, then what is mine, what is yours. So it has a slightly less impact on estate planning, as long as we obviously understand that the person who has died still has to take care of liquidity perspectives. Please don't forget, in terms of long-term relationships, we've got to look at that from a estate planning point of view. Now, from an estate duty point of view, etc., I am still deemed to be a spouse. I have all those Section 4Qs and things like that. But again, important, if I tie back up to the divorce, there is no divorce claim, i.e., if I am in a long-term relationship and there is death that takes place, my surviving partner cannot claim against Maintenance of Surviving Spouses Act. If my surviving partner just before death had become my ex-partner, there is no divorce claim against my deceased estate, where with other marital regimes, remember, anything under a Marriage Act, so anything under Marriage Act, I will have potential Maintenance of Surviving Spouses Act that I can claim if there's not sufficient liquidity for me, or rather not sufficient money for the surviving spouse. And of course that also impacts in terms of any previous divorce claims I might have. That divorce claims might not only be on a pension fund, it can be a individual maintenance. So after my money, after my I receive income after tax, I've got to pay you a maintenance. I die, you've got a claim against my estate because maybe the degree says that I have to pay your maintenance until you die. So there again, I have liquidity problems in terms of estate planning. So I think there we have to be aware of the actual marital regimes and the impact it has on planning, but not only looking at estate duty, ladies and gents, look at other legislation. Maintenance of Surviving Spouses Act, we tend to forget. If we don't leave enough money to the surviving spouse, there's going to be a problem in terms of liquidity. They can use the Maintenance of Surviving Spouses Act, and your whole estate plan is going to go very, very wrong, because I'm going to claim far more money than what you've actually left for other heirs and legatees. From an accrual calculation, remember our framework. Our framework, according to the Act, is exactly what it is here. I'm going to look at my commencement value. It is a net commencement value. They're probably going to give me a CPI, where I have to adjust the CPI value. So I've got to remove the inflationary component out of my accrual calc. Then I'm going to list all my current assets, less my liabilities, less exclusions. I want to look at those exclusions. And then obviously I adjust, I get my net estate, the greater estate less. The smaller estate is the one that has the claim. So it's either a claim against the deceased estate or an asset for the deceased estate, or even divorce. Now, those exclusions are important. I want you to go and take a look at your accrual. The exclusions are under your Marriage Act. Go and take a look there, please. Your Matrimonial Property Act. They talk about what is automatically excluded for accrual. That's important because we've got to understand that, for instance, I'm giving you some examples, okay, or rather some of the exclusions. So if there's donations between spouses, that will be excluded. If there is any inheritance received during marriage, that is automatically excluded. So the important thing to remember here is, if I'm looking at in community property, then any asset I inherit will automatically be included into the joint pot unless it was specifically excluded. So if it's inheritance, of course, the person that has died is the one who has to exclude that asset from the joint pot. But from an accrual perspective, it works a little different. It says any inheritance, so the Act specifically says any inheritance inherited during marriage will be excluded. So whether my dad actually excluded the asset or not from a matrimonial property perspective, it will be excluded. So those are the type of things I must go look at. Patrimonial losses, donations to spouses, inheritance, assets that were previously excluded from the accrual. So if I had, as part of my commencement value, actually excluded any assets, that is also an exclusion. I've got to take it out of current assets. So it's important to go take a look at what is actually excluded, because they're going to, I think if they give you an accrual calculation, they will concentrate on that. Then, of course, what I have done, because there's always so much talk out there when I'm looking at a life insurance policies. Now, remember, you've got to look at what are they testing. Are they testing accrual calc on death, or are they testing accrual calc on divorce? Because those two differ slightly, okay, or maybe differ greatly. And I'm looking from an insurance perspective. Because on death, obviously, policies do pay out. So I've got to look at which of these policies I'm actually going to include in the accrual and which ones I'm not going to. But if there is a divorce, can you understand that policies don't pay out? So what of those policies do I actually include, what do I not include? If you look at death, can you see at no stage here do I actually include pension fund? I don't, okay, because on death, pension fund money is paid out according to Section 37C, definitely not paid into the estate. Where if I look at the divorce, then the value doesn't mean that I'm actually claiming against the fund. It's just the value is actually included for calculation purposes. And that is important. So I'm hoping that those two that I've given you is going to guide you a little bit more in terms of how to do your accrual calculation. But it doesn't mean that you are just going to focus on life insurance. What I want you to do is I want you to be very comfortable with that particular framework, especially your, oopsie, I didn't mean to black that out, apologies. What you have to know is especially those exclusions, because it's those exclusions that we actually get confused with. Sure, we actually have covered quite a bit of your guidelines. I'm just taking a bit of a breather because sometimes I start feeling it in my head that I'm just trying to push through things. We are now going to go through to business assurance, and I'm going to again summarize those business assurance for you. But before I do that, I just want to quickly look at the questions we have. So I've got Tamron that says, to clarify, the person who pays maintenance post-divorce pays the tax. So the receiver of these funds does not have to pay tax on this amount. The receiver, okay. So Tamron, yes. I'm going to clarify, this is maintenance in terms of a divorce. So this is not lump sum. I think we are very used to lump sums. But maintenance, I can do two things. I personally have to pay the maintenance. So I earn my income, my salary, let's say. My salary gets taxed. I then pay, after tax, I pay my ex-husband an income. I was taxed on my income. I cannot use that as a deduction. And my ex-husband, when he receives it, it is not taxed in his hands. If it is a maintenance that comes out of a pension fund, pension provident fund, pension interest, then what happens is the fund is responsible for paying over the income, but it pays the income net of tax, which means that I, as a member, pay tax. So it's considered to be my income. So it's like after-tax income. The problem is from a maintenance against a pension fund is obviously there's tax on tax, okay? Because I've got to draw enough money for it to be income and pay tax to pay net to my spouse. So that has a big effect, obviously, on retirement planning, because I am reducing my retirement fund considerably. So I hope I've helped you out there, Tamron. Heather asks, please explain tax on tax statement. Regular annuity second schedule. I'm just going to do a quick drawing, okay, but I think what I'm going to do, I'm going to make a note here. There's a practice note that SARS issued recently. I can't even tell you what that practice note number is, or a guidance note. And in that guidance note, they actually give a brilliant example on tax on tax. I don't think it's something that you're going to be tested on, because it's quite a calculation. I think if you do get tested on, it's actually just going to be theory rather than anything else. But let me see if I can explain. The award says, I've got to give you 10,000 Rand, okay? Now, the non-member must receive 10,000 Rand. That is the amount of money she has to get in her hands, finished. Now, you must remember, because this is deemed to be the member's income from tax perspective, and let's say, for instance, this member is on a 40% tax bracket, okay, can you understand that for the non-member to receive 10,000 Rand net of tax, that means that I've got to raise 10,000 divided by 0.6. Because that is the tax that gets retained. So let's just come up with a figure. This is just coming up with a figure, ladies and gents. So let's just say for me to pay tax on 10,000, so that my non-member gets 10,000 Rand, I actually have to raise this income that's coming out of the pension fund, and it's got to be 14,000 Rand, let's just say, okay. So I've got to take 14,000 Rand out of my fund, so that after tax, non-member gets 10,000 Rand. But think about this. That 10,000 Rand was inside my 40% tax bracket. But because I've had to increase it to 14,000 Rand, it now goes into the 41% tax bracket. Can you see that? Because of the fact that I'm drawing more, I've increased my marginal tax rate, which means now I've got to calculate what that extra 1% is on this 14,000, so that after all the taxes I deduct, I now can pay 10,000. So all of a sudden, I have to now go and say, well, maybe I should be drawing 16,000 Rand. So that by the time I now get taxed at 41% marginal rate, my non-member, that horrible person that I have now divorced, get 10,000. So my fund is being depleted on a regular basis by tax and tax and tax. Well, of course, besides the fact that I've had to pay 10,000 Rand in terms of fund. But that is tax on tax. So I hope I've helped you out there, Heather. But you know what? It is quite a complicated little calculation. So I think they'll probably just test your theory if it comes up at all. Okay. So it's 1:27, so I've got quite a few things still to cover with you. I think my business assurance note, I've given you quite a bit of detail here. I've gone into, now let's just look at how it is worded in your guidelines. So it talks about, so we're going like this, cash flow budgeting for any person. That is also something, ladies and gents, that came up in the last 2-3 board exams. In the case studies I sent through to you, if I'm not mistaken, because I did go through those case studies in detail to see, I did include a cash flow and budgeting little exercise. Now it talks about any person or entity. But right after that they talk business assurance, the buy and sell, key man, business valuation, succession planning, and then they go business entities again. I don't know why, but maybe because of the lack of a lot of personal guidelines, although medical aid is personal, products is personal, so maybe I'm totally wrong, okay. I'm kind of going, would it perhaps not be a cash flow budgeting from an entity, a business perspective, because they're focusing on business entities, and they're looking at business assurance. So maybe all those three will be mixed up into one, I don't know. But let's just give you, I haven't included cash flow and budget yet because it is in your case study. I think what you've got to do is just try and understand what cash flow and budgeting is about, because there's two slightly different things. We always talk when we go to a client, we've got a budget. But how can we budget unless we understand what the cash flow is like? I've got to work out I think in my mind, just think about yourself. And that's why I think if you do a cash flow and budgeting exercise for yourself, you may then be able to take that over into a business entity, all right? And remember, what is our business entities? Our business entities can be a partnership, can be a sole prop, can be a CC, can be a PTY, so we've got members, partners, shareholders, etc. All those are business entities. So take this principle of doing your cash flow for your personal capacity and your budget and sort of just transfer it over to an entity. It's not that difficult, but of course you've got to understand how to read financial statements as well. So I would start off with a cash flow. So I'd kind of go, where is my money coming from? Where are the sources from my income? Are these regular amounts that come in, or do they differ? Is it ad hoc? So that gives you an idea of obviously how the client, or rather what the client depends on in terms of an income. Then I see, where do these monies go to? Okay, so how much goes into entertainment? How much goes to food? How much goes to bonds? What do I have to look at? Maybe I've got education. Maybe I've got to look at a brand new car. Or can you see what I'm trying to say? Where is this money going to? Now that I've understood my cash flows, my money that comes in and where it flows to, then perhaps I can start doing a budget. Okay, so yes, look at this. I have education that I have to consider. Under education, in 2 years' time or in 5 months' time or whatever the case is, my child has got to go to university to study for some form of degree for 3 years. I have this car which I've had for 10 years. If I continue with this car, the chances are I'm not going to make it to work. So, of course, in 3 months' time, I better have money to buy a brand new car, or this flow of income coming through is no longer going to be there for me to fund the cash outflows. So I've got to start doing a little budget here. When am I going to perhaps get an extra bit of income? Maybe it's bonus time. Maybe it's only December. Maybe I'm on a contract basis and I've got a big job coming up in about 3 months' time. So what am I going to do with this money that I'm going to receive in 3 months' time? Am I going to be able to address all my normal cash flows? Yes, but now I've got a little bit of money extra. We've got to start budgeting for these periods where I'm going to be needing extra capital. Now, it doesn't mean that I have to do ad hoc budgeting. It could be that I know that in 3 years' time or in 2 months' time, whatever the case is, I'm going to be needing capital to fund education, to fund a medical event, etc. So perhaps another thing I have to add here is another cash flow, but that goes into a short-term investment because that's part of my budgeting exercise to address that in 3 years' time. So can you see that that is sort of the cash flow and budget exercise we have to do? What is different if I have to apply this to a company? Is it any different? Well, let's just quickly look. I just want to touch on a few aspects, okay? And you've got to go and pick this up out of the financial statements I've given you, just in case we don't get to those financial statements, because I'm going to try hard to do that, is what type of business am I and where is this income coming from? Is it sales? Is it investments? Do I perhaps have investments and I'm using my investments inflow? Is it interest from people who owe me money? Where is all this income coming from? Then, where does that income go to? Is it obviously costs of sales? Is it salaries? Is it whatever it is? Now, depending on the industry, maybe under my financial statement, you're going to see I've got fixed assets. Well, what are those fixed assets? If I'm a printing company, I'm probably going to have machines for printing, for cutting, or whatever the case is, all right? In which case, do I have to replace that? Do I have to have money to replace that? There's my cash, my income coming in, my cash flows, where is it going, and obviously my budgeting point of view. What if I'm that type of company that has restraints of trades? When will those restraints of trades kick in? Okay, sometimes you never know, but are you understanding more or less where I'm coming from? So, when do I have to budget for these amounts that are going to come out? Those are the two that I can think of. So can you see that just apply the same principles? Where's money coming in? Where's it going out? And what do I have to look out for in the future? That's part of my cash flows and my budgeting. So in there, I'm talking business assurance. So let's just touch on a financial statement, this one. Let me see this one. Okay, I just want to give you an idea, okay, what I'm talking about, then I'll go back to business assurance, because then at least I've actually addressed this particular setup. So look here, my fixed assets have increased. So I need to understand, do those fixed assets perhaps need any form of replacement? If I do, okay, it's going to be part of my budget, and what would I perhaps introduce to make up that capital? Well, from a business insurance perspective, maybe I'm going to be looking at sinking fund policy. So can you see how I've identified a budgeting exercise here, because I know I'm going to have money to replace, but what do I do from a business assurance perspective? I'm going to be looking at a sinking fund policy. Now, of course, I've got a lot of accounts receivable, and I'm sitting with a lot of cash. Okay. Of course, I'm going to have to look at the notes. Sorry, these things didn't come out properly. To see what is that all about, okay? Well, I've got quite a bit of liabilities, so should I perhaps not be paying some liabilities off? Okay, long-term or short-term, it doesn't matter. But why am I sitting with so much cash? Is it just in a bank account? Can I actually take that and do something else with that? Can I utilize it in another type of product maybe? For budgeting exercise, does a business assurance come in here or not? Let's see what else I can pick up on. There's a lot of things I can pick up on here, but I just want to tie it up obviously with insurance, business insurance. Just let's look here. Look at this. Lot of money that is owed. So could I be looking at a contingent policy? Maybe companies should be taking out a policy on the life of these individuals, or the other way around, because one of them dies, someone is going to have to pay someone money. But then at the same time, let's just go a little bit further, and I'm just picking up on some, ladies and gents, there's a lot of other things that you need to pick up on here, but let's look at here. Yeah, I've got two main members. Do I have a buy and sell? Okay, so question, do I have a buy and sell? But look here as well. It seems like Alan gets quite a bit of money. It looks like Alan gets paid more money into his retirement fund, etc. than Sharon does. So is he perhaps a key man? So should I be looking at a key man policy? So are you picking up from this financial statement? Because I think that's more or less what they're going to be doing. Besides the ratios, I've given you a lot of ratios to look at, okay? But I think what they're also going to do is they are going to give you some form of financial statements. Could be a cash flow, could be income statement, could be also a balance sheet. And you're going to have to read the information in that setup, in that statement, and going to go and say, well, what business assurance can I apply? Okay, what are the risks? What can I plug in? So what is a buy and sell about? Obviously, a buy and sell is where I look at if I've got a CC here, for instance, and I've got members in the CC. If it's a PTY, clearly I've got shareholders. It can also be a partnership, ladies and gents. Partnership can do a buy and sell. It can also be a sole trader. A sole trader can also do a buy and sell, because all I have to do is go find another financial planner who's keen to take on my business. So I can do a buy and sell with him. I don't have to have any form of entity to be related to. That obviously impacts tax. You just have to understand the implications of tax. But what is a buy and sell about? It's really to make sure that should one of these people die, become disabled, have dread disease, or even retire, we concentrate buy and sell too often in terms of death and disability. Don't forget, one day this little individual also is going to want to retire and go to the Bahamas and not want to know anything about you. Who's going to buy his shares? Do we want him to sell that shares out in the market? Maybe not. So this is what we enter into, is a buy and sell amongst shareholders. Of course, we also have share buyback. where the company buys back its shares, and we can do that for many, many reasons. And just in case you have something like that, why would I go into that situation? Well, you might have this little individual who has only a 5% share in this company, and you might have a trust, and this trust has 95%. I've just used the trust, guys. It can be anything. And of course, this individual, maybe what I should do here is take away that trust, because I can see there's going to be complications with my explanation and you might be a bit concerned. So let's take this individual's got 95%. Okay, so of course the way the structure works is this one takes out life insurance on the life of that one, and that one takes out life insurance on the life of that one. Can you understand that this one has got to take a policy worth 95%? So if this company is worth 100 million, this premium is going to be very, very heavy. Might not be able to afford it. So how can I perhaps, on the death of this little green person, how can I then make sure that my little blue person is actually the only member of this company? Well, the company enters into a share buyback so that when my green person dies, the company has 95% of the shares, and he cancels shares issued. They're still authorized, but they're not issued, and now all of a sudden this little individual is in control of that little CC. So you can do it in those two ways. Otherwise, I think, ladies and gents, if you do go through my buy and sell notes, it's very clear when it becomes a state dutiable, and what we do with CGT as well as state duty. And by all means, there's my email. Go and question it. So let's go into what is Keyman, or I think the next one is Keyman. Let's go into, well, I've given you a lot of information there. I think if you read it and go through those examples, there's just no way you can go wrong, ladies and gents. But again, you can definitely query it with me. I've given you capital gains. I'm giving you company-owned policies. I did send these notes to you, but I don't think that they're going to be testing you on the Section 11W at all from a deduction point of view. I don't think, for some reason, I didn't get that impression from your guidelines, okay, because the tax calculations, I sort of tied it up with personal rather than anything else, purely because of where it's sitting in your guideline. I might be mistaken, but I've given you the whole 11W there. Don't think they're going to go into that. But company-owned policies, we've got Keyman. Now, what is Keyman? Keyman is purely what I was saying earlier on when we looked at that statement. I can have a whole lot of members in this company. It can also be an individual that has nothing to do with the membership of the company. So it can be just an employee. But I think the more complicated bit is if I have a shareholder who is also an employee of the company, and that person is a keyman. A keyman is really, what happens is if that person does die, if that person dies, becomes disabled, has a heart attack, etc., then there's going to be a loss for the company. And we tend to look more of a revenue loss than anything else, because maybe this person is the only one who can actually market and bring in the clients, or maybe I'm the only one that the clients actually trust, etc. So on my death, this company is going to have a huge impact in terms of revenue. And what the company actually needs is, when I die, the company needs a whole big capital injection, maybe to bring someone else in, maybe to secure all the clients and keep them comfortable, maybe to train someone else up. Whatever they're going to use that money for, that's what Keyman is all about. Now, the Keyman policy is structured where the company must be the owner, the company is the beneficiary, the company is the payer. Don't structure it any other way, and do not make it for the benefit of the life assured, because that is not Keyman. You just get into trouble from taxation and a state duty perspective. The premiums can be deductible or not deductible, and that's where 11W has come in. And of course, what happens is when this policy pays out, it is gross income in the hands of the employer. It is gross income in the hands of the employer, but then depends on whether I have had a deductible or not. It is also exempt. estate duty is important. I'm going to touch on estate duty because remember, this is a policy due and payable on the life of the deceased. So it does become estate dutiable, but again, it's got exemptions. And if I meet those exemptions, the policy is not dutiable. But if it does not, and if it's a family company, it does become dutiable. The policy will increase the value of the shares. The policy will increase the value of the shares. So on the life of the shareholder, or rather, on the death of the shareholder, your shares have increased. But then also what happens is the policy becomes dutiable. So you'll notice I am taxing two same assets in a way. So what happens is, please don't forget, I have a section 4P deduction that is allowed so that it places the shares the shareholder money. It could be that the shareholders took surety for the bank, etc. So what you're really doing is you are applying some form of cover, obviously on a particular entity here. It's got to be on someone that can actually die, so that when that person that owes you the money dies, there is capital to pay out that loan. And the reason why we sometimes say contingent is because if this person has stood surety for the bank, then obviously when this person dies, the bank will first go to the company to see whether they're going to call in that debt or not. And maybe even if they call in the debt, the company has got reserves to pay the debt. But just in case the company does not have reserves, the idea is that the company takes out a policy on the life, why doesn't it want to go purple? Take out a policy on the life of this individual so that when that individual dies, money gets paid out to the company so the company can settle the loan with the bank. This is all capital in nature, so you cannot deduct from an income tax perspective whatsoever. You've got to go take a look at the CGT aspects of all these policies, and you're going to see the nice thing is that the minute I'm looking at a risk-only policy, Para 55 1E says, whenever you're looking at a risk policy, there will never be capital gains tax. That's important. So capital gains tax will only apply when and if there is a cash component on the policy. If I'm looking at a restraint of trade that has to be paid, this is obviously a condition that when you join me, you can join me, but should you leave, you're not going to touch my clients, or you cannot go into the same form of industry, or you can't work within a 50-kilometer range. Of course, it cannot be unconstitutional. You cannot stop me from earning an income. But of course, you're not going to sign any form of restraint unless there is some form of compensation. So what I can introduce here is that sinking fund policy, the same sinking fund policy that I was making reference to in terms of having capital for fixed assets that have to be replaced. That's something that I can introduce from a sinking fund perspective. There is no life assured, so there is no estate duty that actually applies. There's your income protector. And I'm looking at where the premium datum which became the policy 0112. I want to see when is the 11A stock. Can start on 11W. Can the policy be seeded? I see that I haven't actually got, oh, there it is. Oh, it's 2015. Oh, my students were actually wrong. They told me it's 2014. Maybe I had it the other way around. Okay, so here's clarity for everybody. I don't have to come back to the 11A in terms of income protector actually stopped 1st of March 2015, not 14 as I was saying. So obviously with my students I was debating it the other way around. I'm not going to touch deferred compensations because although that's business assurance, I don't think it's part of what they're actually going to be after. I might be mistaken, but the notes are there. Please go through and read that as well. Okay, so I have summarized it in quite quickly. There are some questions I want to look at, but again, ladies and gents, I will need you to be free to email me and ask me questions. I'm sorry that we started a whole hour late, so I'm going to be so much kinder to you when you actually do send me those emails. Much, much kinder. I saw a question pop up, but I can't see any questions. It could be that it's slightly delayed in me getting it, which is not a problem, because if I don't answer it now, I will definitely be answering it a little later. Okay, so what have I not touched on? I have not touched on ratios. Because, of course, it says there business assurance, buy and sell keyman, business valuations, succession planning. Okay, succession planning is all your buy and sell, your keyman, etc. Okay, so that obviously becomes important, because should I die, should I retire, should I have a heart attack, how do I continue this business? So that's obviously important to understand from a business entity point of view. If a shareholder dies, the business doesn't necessarily die. It will continue. But the shareholder could be the key person. Or the shareholder, of course, is being a shareholder, how do I do the shareholder or the member? How do I do a buy and sell? Or rather, where do my shares go to? If I'm a partner, if it's a part in the partnership, you understand the partnership ends. So what type of succession planning do you have there for the partnership to then reignite itself at a later stage? You've got to start a new partnership. If it's a sole trader, of course, I die, everything dies with me. But I have dependents. Maybe they need some form of income. So what type of succession plan can you put into from a sole trader perspective? But they have spoken about business valuations. And you know, there's so many business valuations that we can use there. So again, it depends on what they're going to be asking you. But remember, I think this is not going to be, I think with our postgrad diploma in our exams, more often than not, there is a direct question. So they do ask you to do an asset ratio or to do whatever type of ratio. But I think from an exam perspective, the board exam perspective, I don't know if they're going to be asking you directly. I think the question is going to be indirect, and you're going to have to understand what ratio to actually use to answer that particular need or that particular concern. So what I have tried to do for you, if anyone out there knows of any other values that I have perhaps not covered here, by all means let me know. I've seen a lot of you have already sent me emails with a lot of material that you'd like me to share with everybody. Thank you so much. I'm very grateful with that. I'm going to have to send it by FPI because I don't have your distribution list. So I only have those that have actually contacted me. But those of you who feel that there are other values that I can look at and you want to share it with all the other delegates, by all means let me know. I will go and chat to FPI right after this to see how I can communicate with you with all this documentation. I have got an idea, but I have to run it past FPI first to make sure that they're happy with it. And then we will communicate with you, okay? But what I have tried to do here, and it's quite a few pages, as you can see, quite a few pages of calculations or ratios. But for every ratio, I've given you that example. I've pulled out information from this statement. It's a very small statement. I have pulled out information from here. Then I've gone and I've said to you what those ratios actually mean. You know, it's easy to say calculate current ratio, but what does it actually mean in relation to the balance sheet? What would it mean for us in terms of making a particular decision? Okay, I'm just kind of highlighting the ones that are sort of, yeah, that we need to look at type thing. Okay, I don't know if this is what's going to come up, but I'm just kind of going, what has been the trend in the past in terms of that? And I think that is important. If we're looking at succession, if we're looking at business assurance, you know, you can't go and introduce business insurance. Let's say for instance you want to introduce a pension fund. You can't go and introduce a pension fund if you work out that this company is not solvent. It's not going to work. Okay, so you have to actually start looking at some of these value ratios. Oopsie, what am I doing? I've got to calculate these ratios and kind of go, Well, which one must I use and what does that actually mean to me? What should I be using, which ratio? I have put here calculate super profits because that's a calculation of goodwill, etc., and a couple other things. And this is over and above the normal profits that one makes. And I've given you sort of a little summary of how we can calculate and what it actually means. But I notice once I've included this, I notice that I did not give you sufficient information to do the whole calculation. But I'm sure that whichever ratio that the examiner is going to want you to work on, I'm sure they'll give you all those relevant facts in any event. So I'm hoping that by putting this together and sending it through to you, that, yeah, and you can take it into the exam, it's open book, that at least it will guide you in terms of what can be asked, how to calculate it, and what it actually means. And you just have to apply it, ladies and gents. Please don't just leave your study here. I have just summarized just such a little bit, and I've only looked at the more key components that I feel comes out of your guidelines. I never know what is happening in these exams. I get as surprised as you do when those questions come out. Sometimes I get very excited that, yes, you know, I was right in thinking that perhaps that's what they were going to be looking at. Yeah, and don't leave it here. I want you to please go and research. I just want to see if any others have come through. Yes, Richard has asked a question. Can a trust be a party to a buy and sell agreement? Yeah, most definitely a trust can be a party to a buy and sell agreement. Let's just quickly go and draw this picture here. And if you go into the SARS website, actually, there, and you just sort of do their search engine, buy, sell, trust, buy and sell in trust, I think that will come up with a beautiful little document. Because what you have here is you obviously have a company here and you have this individual that owns shares and you have this trust that owns shares, or maybe you got two trusts that own shares and you don't have an individual, okay? But let's just complicate things a little bit and have an individual and a trust. I hope the system doesn't automatically close at 2. I think it does. Otherwise, Richard, you're just going to have to be in touch with me afterwards, and those who want to understand trust. So, you must remember, I have shares in this company, the trust has shares. So, when this individual dies, clearly the trust wants to buy his shares, so the trust can acquire a policy on the life of the individual, so that when the individual dies, money gets paid out to the trust, and the trust then buys this person's shares out in terms of via the executor of the deceased estate. There is a difficulty in that this could potentially be estate dutable. Why? It can't be the trust that acquires the policy. It's got to be the trustee that acquires the policy. Not too much of a problem, I don't think, but because if it's a state duty, all you have to do is increase the policy for state duty purposes. But now, I think more often than not, the people tend to ask, but when the trust doesn't die, but what if this person somehow wants to buy the trust shares? Would we want to? Well, you must understand more often than not when planning takes place, before the shares went into the trust, you probably had a little individual that owned the shares directly. Some planner came along and said to this little individual, you know what, dear sir, if you die, all this becomes estate dutable, whatever the reason is, let's move the shares into the trust. Trust me that this person will be a trustee in the trust, and this person will still remain very involved and active, so it could be the director as well. So this person here is very nervous that should this trustee, who's now sitting in this trust, dies, you have a whole lot of inadequate people, sorry for using that word, inadequate people that is going to be making decision-making on behalf of the trust for the company. So I'm very nervous. So what do? I take out a policy on the life of this trustee so that when this trustee dies, I have money to buy the trust shares. Couple of problems. Problems of this. The State Duty Act says that the purpose of the policy is to buy the deceased shares. So am I buying the deceased shares? No, I'm not. I'm buying the trust shares. So the policy is going to be estate dutable. Next little problem that, well, when I say problems, everything that can be overcome. But remember, important, what does the trust deed say? The provisions in the trust deed are very important. Why? Because if the provisions in the trust deed does not allow the trustees to sell shares in this company, you cannot enter into a buy and sell. It can then only be a one-sided, where the trust buys the individual shares. So very important before you start recommending buy and sell policies with the trust is read the trust deed. If the trust deed says the trustees can do what they want with the shares, they can sell it, they can flog it, they can whatever, then of course a buy and sell will work. But you can most definitely enter into a buy and sell with trust. So I hope that has answered your question, Richard. And the next question, I can't pick up the next question. No other. Okay, yeah, I think here it is. Rudolph, I think it's you. Because you have used sinking funds multiple times, is it possible to use a different investment vehicle other than a sinking fund when saving up to replace assets? Rudolph, most definitely. I know I use sinking fund policy. I know I use sinking funds. It's because a sinking fund doesn't have a life assured, so there's never ever estate planning, estate duty consequences. But no, by all means, you don't have to use sinking funds. You can use whatever. Okay, money markets are not always ideal because money market is short term, but you can use, Rudolph, whatever investment you are comfortable with that meets the same objective as a, not that, there I go again, same objective as a sinking fund, no. As long as it meets the objectives of the client. So, for instance, if the client needs the money in 3 years' time, I don't know if I would put the client in a investment vehicle that really should only be drawn in 6 years' time or 7 years' time, because then that is not actually meeting the client's needs. But by all means, I've just used things that I sort of generally spew out, but totally up to you in terms of what you want to use. Just apply it back to the client, and please just make sure it meets the client's needs. That is important. Okay, it doesn't look like I've got any more questions that have popped up, but I know that Kirsten is making sure that I've got all these questions that will come my way. So if I pick up anything that I have not addressed, or please address it, send it through. So let's just quickly summarize. You have got my email address. So if there's anything you're going to, please email me. I'm going to, as soon as I finish here, I'm going to quickly chat to the FPI, to Fatima and Amanda, to find out how we can actually communicate all this extra information to you without you being inundated with documentation. Also, not to have additional admin on FPI, so I'm going to try and do that as well. And then I hope all my notes have helped you. And I think, yeah, I think from now on it's just a matter of research, study, be confident, and read the facts, understand what's being asked, and apply. Don't just do a calculation and full stop. Apply your knowledge, your skills, and your ability, and look at what type of client you are dealing with. So ladies and gents, good luck with this exam. Believe in yourself, and yes, I would like to know how many of you actually made it or not. Either way, it does not matter. But thank you very much for your attendance, and I hope it was worthwhile. Good luck.